On the FTSE 100, pointing lower by 0.4%. Slightly less negative picture over in Germany, but still the downside being flagged at 0.2%. The CAC current pointed lower by 28 points, Anna.
Okay, so expectation then from the futures picture is that we'll see a bit of weakness at the start of the European trading day. Not getting much of a clue in terms of risk appetite from the FX markets. It was there just a moment ago. There it is. Euro's pretty flat. The dollar's pretty flat. The pound also pretty flat as we go into another trading week. And as we were discussing last week we had a lot of set-piece central bank events. Yes, this week we've got data, PCE, inflation data, European inflation data. All of that will be really important, and the oil reports. But maybe a few more unpredictable elements to keep in focus. The shutdown conversation, the strike conversations over in the US, even if some of those being resolved at the margins. This is what we see then for European stocks, down by 0.4% on the Spanish IBEX. The French CAC 40 also down by 0.4%. The FTSE down by 0.3. So actually not seeing much of a divergence around the commodity story. Weak iron ore will weigh on London, but it seems to be kind of in keeping with the rest of the markets. The German DAX down by 0.3%. This is the picture then for the sovereign bond markets. We're selling stocks, we're selling bonds. We've got a little bit of strength coming through in these yields. Mark was flagging the 30-year Treasury yield to us earlier on. And I mentioned the weak iron ore price. Well, that certainly is not what is showing up on the commodity space. Just as Mark was talking to us, we're seeing a little more strength in the oil price as we go through this morning. We focus on the data on that front this week, and a bit of strength in natural gases, and perhaps natural gas, and perhaps that is weighing. All of that commodities green is outweighing any negativity around iron ore for London then, Tom, in terms of the stocks trade.
Well, breaking out the energy story then, the energy sector is currently down 0.2%. But basic resources is taking the biggest hit across your major sectors as a result of the softness in that iron ore price. So basic resources as a sector currently down 1.7%. Energy off by a little marginal kind of 0.2%. And we continue, of course, to reflect on the hedge fund positioning around oil, and of course the Cushing data that we're getting out later this week. Other big movements coming through across your sectors. You're looking at downside in terms of travel and leisure of about 0.8%. The auto sector's taking a bit of a hit as well, off by 0.6, and retail also lower by around 0.5%. Every major sector in the red this morning, so that negativity permeates through these sectors, but it is being more pronounced across retail, basic resources, travel and leisure down more than 1%. And again, across your benchmark, European Stoxx 600 off currently in the session, early days, of course, by 0.3%. There's some breaking lines crossing now around Amazon and an investment. So switching focus to technology, investing as much as $4 billion in the AI startup Anthropic, which is based in the US. The line coming through that Anthropic will use that Amazon investment and Amazon chips to build and train AI models. Amazon partnership with Anthropic will boost generative AI efforts. So we know, of course, that Amazon has AWS, the cloud data and cloud services, cloud center, data centers, part of the business, so important for Amazon in terms of the revenue driver. And of course, they have their own chips. So now partnering with Anthropic, which was set up by some previous executives, people who used to work at OpenAI. They're now rivaling OpenAI. Previous investment for Anthropic has come through from the likes of Google, but also Alameda Research, which was linked to Sam Bankman-Fried as well. So slightly more controversial funding on that front. But the Google backing is important, and now the Amazon backing as well, to the tune of what, about $4 billion as the competition around generative AI really starts to heat up, Anna.
Yeah, absolutely. And I think Amazon was seen as a bit of a laggard amongst these big US tech players on the AI front. So interesting to see this announcement from them today. Tom, let me take us to the Swedish property sector, where we have some movement on SBB. We mentioned this, Joe Easton mentioned this in our stocks to watch this morning, and it certainly has proved itself a valid stock to watch. SBB gains as much as 38%. You can see it up by 37% in session today then in Sweden, as the business gets a $720 million investment from Brookfield. So they've got that money from Brookfield, and they are, as a result, in a much stronger position, it would seem, on the balance sheet. That's what the market is concluding, and the stock goes higher today. Interesting, as I mentioned earlier, to see that the central bank is being asked about this over the period of last week when we heard from the Riksbank, and they were saying that there are, of course, the ones that are in the press for distress on their balance sheets, and then there's the rest. So we'll see how this story develops from here, whether this is ring-fenced sufficiently. Sam Unstead joins us from our equities, from the Markets Today blog, of course, to take us through some of the stories that you focus on. I was too focused on SBB there, Sam, but now let's turn to other matters, and in particular the pound. Really interesting story and commentary over the weekend, talking about how the pound, a year ago, was really beaten up by the Liz Truss administration, the after effects of that so-called mini budget, with the sort of maxi effect on the currency. And now the pound perhaps finds itself a little under pressure again. What are you watching?
Yeah, so I mean, you mentioned this morning the pound sort of flat this morning, but it's flat and hovering around those kind of 6-month lows that we hit over the course of last week. As you say, over the weekend, it was the anniversary of the mini budget, and now you're seeing a lot of bets coming in on the pound to fall even further, because the Bank of England has gone on pause. That is refocusing everything on the fundamentals of the UK economy, and they don't look too rosy at the moment. And so there is a lot of bets going in that the pound versus the dollar is going to be a winning trade.
Yeah, watching the next level for the pound then, as we weigh up the downside coming through for this economy. You're also looking at a bit of this controversy once again swirling around the Prime Minister Rishi Sunak here in the UK, around how he's thinking and how his team are thinking about investments in rail infrastructure.
Yeah, and HS2 in particular, HS2, I mean, a conversation topic in this country for, I don't even remember how long.
And like
I think it probably is actually very close to that. Yeah, you're quite right. This is actually coming up as well to the party conferences over the course of the next month. So the sharpness of the criticism is likely to increase a little bit as you go over the course of this month, with an election likely next year as well. And certainly, the initial indication appears to be that they are at least considering walking away from a part of that line. And there's actually some criticism out this morning already from, I think there was a lead in the Times, I believe it was this morning, from George Osborne and Lord Heseltine, sort of criticising that decision. Yes,
there's a lot of kickback against it, and we're heading towards Tory party conference, basically heading towards all of the party conferences for the UK political parties. What are we expecting from the UK, from the Labour side of things? If HS2 is going to be one of the focuses for the Tories, what are we expecting from Labour?
I think you're expecting a very different Labour Party to the last couple of elections. The last couple, led by Jeremy Corbyn, very different kind of view towards business and very different noises made towards business. Their party conference this year is going to have a lot of major companies, major corporates there. The British private equity trade body is going to be there. So it's certainly a very different pitch from Labour this time around.
I love the headline in the BN. UK's Labour Party swaps Mao jokes for business charm offensive.
Yes.
And so that is what is expected to come through at that party conference. Sam, so thank you very much indeed, walking us through some of the key things to be watching with a particular lens on the UK, of course, from our Markets Today team. You can get more from the team on the front page of the Bloomberg UK website, or by typing TLiveGo on your terminal. Let's check in on some of the individual stocks on the move. And Joe, you called some big ones, Joe.
So these gambling stocks are opening lower in the UK and also in Ireland as well. Entain now down around 4%. They do warn of a weakening in some of their gambling spending revenue over the summer, and also particular weakness over in Italy, notably. Jefferies analysts saying that they will cut earnings estimates by around 10% for the next 3 years. And we're seeing read across over on Flutter as well in Dublin. Now, SBB, as you said at the open, they're absolutely rocketing earlier, up 28% now as they get this $720 million cash injection from Brookfield over in Canada. They do have around $8 billion in debt, as we said, in stocks to watch, but this is a big boost for that stock, clearly, as we see on the screen here. In terms of the high-speed 2 rail issue that Sam Unstead was talking about there, this is a negative for Balfour Beatty. They make this railway with Vinci over in France. Vinci's a much bigger company, though. Balfour has a market cap of around 1.5 billion, and it's an important project for them. And that stock is slipping around 1.3% after reports that Sunak could be looking to shelve the northern part of that line, the part that goes between Birmingham and Manchester, a negative for that building company this morning. Then we'll have a look at some of the mining stocks, all deep in the negative there. This, of course, coming from the news of iron ore futures slammed over in Singapore, down 4%, a massive drop, adding to an 8% decline from last week. So Anglo American and also ArcelorMittal, the two here, those ones are some of the biggest producers of the metal and among the biggest decliners, but we're seeing red across that sector this morning. Then on the ratings changes, Bank of America swaps Gucci handbags for charm bracelets. They downgrade Kering, becoming the only broker with a sell equivalent rating on that stock. They say that Kering has become a cyclical stock because it's so exposed to aspirational buyers, the Gucci brand, and they're warning there that that stock could start declining soon. Pandora they like, given the valuation, and they say it's showing a bit of strength in some of their sales at the moment. In terms of Ubisoft, this one is upgraded over at Exane BNP Paribas. Interestingly, they cite the Star Wars game that's coming out from Ubisoft. They say that's the boost there. So the force is with that stock this morning. And AstraZeneca, this one gets an upgrade over at Jefferies, who says that the cancer drugs are strong, but the non-cancer is also positive as well. The asthma drugs boosting the stock. They upgrade their earnings estimates and lift Jefferies on AstraZeneca to buy.
Joe, thanks very much. Joe Easton from our equities team with plenty of stocks on the move this morning. Let's get a briefing on what's coming up this week. Today, we'll get Germany's IFO Business Climate Survey, so that's going to be a feature of Monday's trading session. Then on Tuesday, US data, including new home sales and consumer confidence, will be released. On Wednesday, the French budget for 2024 will be unveiled. President Emmanuel Macron has promised to find at least 15 billion euros of savings to cut the deficit. We are expecting him to make some comments on green issues today. On Thursday, we get a barrage of inflation data from several European countries, including Spain and Germany. And later in the day, Nike earnings will be coming out, so we'll watch for any read across into other listed sportswear makers, for example, the likes of Adidas. And on Friday, the Fed's favoured inflation gauge, PCE, will come out. So, Tom, a real focus on inflation then at one level with the European data, the US PCE data. We're going to get some central bank speakers as well, trying to add their steer, I suppose, on what we heard last week. And as Mark was saying, quite difficult to draw fixed conclusions about last week from all of those central bank meetings.
And some more volatility then in the docket or in the cards around the Treasury markets as well. Interesting, the Bank of America says the 10-year yield could get to 4.75 and peak out there. Of course, that debate remains live in terms of how much more selling pressure is going to come through, particularly for the back end of the Treasury curve, and maybe some of those Fed voices and that inflation data will help give a little bit more clarity. Coming up, UBS says it is working at, quote, full speed with the integration of Credit Suisse. We're going to speak exclusively to the CEO, Sergio Motti. That's later in the show. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
There's a lot of information we need to collect. We will not be satisfied that we are where we need to be until we see inflation confidently. We're confident that it's on a path back to price stability, because the American public, as much as they're getting relief, you all didn't ask for us to just get a little relief and call it a day. You really asked us to do our job.
That was San Francisco Fed President Mary Daly giving her thoughts on the Fed's inflation fight. Let's bring in Raffaella Denconi now, founder and managing director at ADA Economics. Raffaella, we've been discussing on the show this morning the confusion, really, the lack of clarity on the picture around these central banks, the Fed, of course, included, that maybe last week there'd been an expectation and we would have a little bit more clarity in terms of the trajectory going forward. But we're looking at a picture now where dot plots are flagging an interest rate of around 5.1% by the end of next year, so fewer cuts than expected, a soft landing, a Goldilocks landing, but also, of course, concerns, deep concerns about recession risks coming from other parts of the data set and other views from economists. How much clarity do you have, Raffaella, as we think about the Fed speak that's going to come through this week, as you project out to 2024, right now with the focus on the Fed?
Good morning and happy Monday. I have to say, I don't really think you're going to get a lot of clarity most of this year, frankly. I think the central banks are very keen to restore their credibility. The labor market is likely to remain tight. I mean, we do have the US shutdown, which near term, but broadly speaking, you do have a structurally phenomenally strong labor market with the strikes on top. So I think that the central banks will remain essentially very hawkish through the end of the year. But fundamentally, what the dot plot said to me was that 5% nominal interest rates is neutral for the US. So it's compatible with high growth, which I think it's 150 basis points too high. So I still have a strong conviction that next year you'll see big rate cuts and exceeding what market expects in the US and in the Eurozone, because I think you will see investment faltering in the next few quarters, and that is what is going to make the central banks rethink their communication strategy into next year.
Okay, good morning to you, Raffaella. So you expect investment to falter. Why so? Why now? Why did it not before? Is it a story of resilient balance sheets being degraded for US corporates? Why will things suddenly become much worse on the investment side?
Well, so far, you had a lot of structural support because since 2008, corporates have increased their cash balances and profitability has been really robust. Also because, especially in the US, consumption was staying strong. But as you go into next year, and the communication of the central bank remains that interest rates will stay this high, I mean, corporates will really need to face much higher funding costs. I think implicitly, a lot of companies were just hoping that the central banks will stay hawkish this year, but borrowing costs will stay much lower next year. So I think the uncertainty for me is very important at this stage. Second, the fact that you do have some slowdown in US household consumption as savings are run down. And actually borrowing costs, they're objectively very high if you need to do investments. So the first thing they're going to do is to cut CapEx.
Raffaella, you have a view. I want to get your view and kind of unpack the forward look on Europe? Because I wonder how you square the view. One of the lines from your notes to us says, don't be too gloomy on Europe. And yet you think more cuts will come through next year from the European Central Bank. How do you square those two things? Presumably the cuts come through because the economy is doing badly, and yet you say don't be too gloomy on Europe.
Okay, so first of all, we're saying the ECB will take the refi rate to 350 next year, which is lower than where we are now, but it's quite high in historical terms. So I would say the first thing, take stock of the fact that the Eurozone can expand even at much higher interest rates than before. Second thing is, in the very near term, I think the manufacturing sector is pivoting and is going to actually improve in the next few quarters. So that's my message on why don't get too gloomy. But especially for the Eurozone, where the war is really next door, investment is really important. Don't forget that the European Commission has an enormously ambitious target to raise investment spending in the EU in order to finance all of these transitions that they're trying to do. So if you're going to raise investment, you definitely need lower cost of capital. Definitely, you don't need a recession, right?
Okay, so the focus on the Eurozone often around the more industrial side rather than the consumer side, but looking at something that is really interesting on the consumer side out of Germany, Raffaella. I saw some headlines today talking about the German house prices falling at their steepest pace since at least 2000. It's not necessarily a news story because they have been falling since the end of last year, but they've been weak for a very long time. When do you see any kind of turnaround for German data on any front?
Well, I think Germany has a structural growth problem. So I think people shouldn't completely put in the same basket the Eurozone outlook and Germany. Germany is definitely going to be a laggard for several more years. In manufacturing, if I'm correct, that Chinese stimulus is going to feed into European data, into the end of the year and into the first part of next year, German manufacturing will show that already in the next few months. But consumer spending and real estate in Germany, I think it will stay weak for several more quarters.
Raffaella, thanks very much for your time. Raffaella Zenconi, founder and managing director at ADA Economics. Coming up on the programme, we'll stick with the real estate theme. Swedish landlord SBB is surging more than 30% this morning after its deal with Brookfield for a cash injection. We'll dive deeper into that story next. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under
tightening would be a worse mistake than over-tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Markets Today, 23 minutes into a European trading session that looks a little bit weaker. US futures, though, point higher, 0.4% higher on NASDAQ futures. Let's go to the property sector. Shares of the Swedish landlord SBB are surging this morning. The company has agreed to sell a 1.16% holding in the education division to Brookfield, a deal that would get SBB $720 million of cash injection. Joining us now, Bloomberg Stockholm Bureau Chief Charles Daly. Charles, good morning. Thanks for telling us this story. So what do we know about the deal this morning?
Hi, good morning from Stockholm. Yes, SBB has struck a deal with Canadian investor Brookfield, which already owned 49% of this education division. And what that means, the stake now essentially means that Brookfield becomes the majority owner in this division. And then that in turn will become a standalone entity, allowing it to raise financing and in turn hopefully improving the overall credit profile of SBB.
And Charles, you know, of course, but maybe some of our viewers don't, that SBB was kind of the unfortunate poster child of the challenges around the real estate sector in Sweden. Does this mark the beginning of the end for SBB in terms of its travails and the broader property sector in Sweden? How much of an uplift does this come through in terms of the corporate, but also the broader sector?
Yeah, I mean, obviously the equity investors are cheering the news this morning with shares surging. But I think it would be wrong to say that the company is out of the woods yet. It has a debt pile of nearly $8 billion, and it obviously needs to sell assets, it needs to raise equity, and it needs to find further equity partners such as Brookfield. So the challenges it faces are still huge. As for the wider property sector, I think you're absolutely right to flag SBB as a poster child for this crisis. All I can say is I think it will probably have a good signaling effect for other companies in the sector, but to say that the broader industry is now on a path to recovery, I think would be premature.
Okay, Charles Daly, thank you very much indeed. And the latest when it comes to SBB raising some capital, so a little bit of relief coming through. The stock is up strongly. And Anna, we've been looking at lines as well, China's reaction to this EV probe by the EU, and of course, at a time when the Trade Commissioner is on the ground in China.
Yeah, absolutely. So Valdis Dombrovskis, EU Trade Commissioner, visiting, making these comments about de-risking, not decoupling, but all of this coming under the cloud of the recently announced probe by the European Commission into EVs. And we're getting these lines through from China. They then saying this morning that the EU's planned measures on EVs are not in anyone's interests.
Also getting a couple of lines as well when it comes to the European Central Bank. Just very briefly, we got data coming out later this week around inflation from the ECB. Villeroy, Bank of France, but also a governing member of the ECB, saying the ECB should focus on persistence, not pushing rates up.
Okay, coming up, UBS says it's working at full speed with the integration of Credit Suisse. We'll bring you our exclusive conversation with the CEO of UBS, Sergio Ermotti, speaks to the programme. We'll bring you that conversation. This is Bloomberg.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. European shares fall after a negative session in China amid mounting concerns from the country's real estate sector. SBB shares there surge after the troubled Swedish landlord receives a $720 million cash injection in a deal with Brookfield. Plus, the EU's trade chief warns China the bloc will be more forceful in upholding fair competition. Tom, so I mentioned there the negativity coming through from Asia, the way we saw weakness in the Chinese session, the property sector in focus, but things turning around and actually coming back to the flat line for European stocks.
Just ticking into the green right now for European stocks. And if you look at the benchmark right now, it doesn't tell the full story. It would look pretty dull because it's flat. But the previous picture, of course, you take that into context in terms of the downside that had come through at the start of the open 30 minutes or so ago, and you were down about 0.3%. That has turned around, so we'll unpack the catalysts around that. The DAX currently posting gains of just 3 basis points. The FTSE 100 still in the red, down at about 0.1%. Certainly basic resources as a drag there. The banking sector, though, is coming through with a bit of a lift. Very modest, of course, for these European stocks. Let's have a look at how the sector breakout is shaping up then around 30 minutes into the trading session. And as you can see, it's the banking sector that is one of the sectors now in the green, getting about 0.6%. Industrials are gaining just 0.1%. Retail is flat. But yes, a turnaround. The pressure still coming through for travel and leisure. The pressure still, of course, coming through for basic resources, down 1.6%. But broadly, unch on the benchmark, but that's not telling the full story. There has been a bit of a turnaround in sentiment, very modest as it is, Anna.
Yeah, absolutely. So sentiment improving a little. US futures pointing a little higher, up 0.4% on NASDAQ futures, for example. Let's step away from the immediate mood in markets to the bigger picture, consolidation in the banking sector, in fact. UBS Group CEO Sergio Ermotti says the business is making good progress on the Credit Suisse integration. He sat down with John Liu, Bloomberg's managing editor for Greater China, for a wide-ranging interview on his first trip to Beijing since taking over UBS.
Things are progressing very well. We made shift, very swift progress in integrating Credit Suisse. We closed the transaction in record times, also thanks to the big cooperation of regulators across the globe. And that's one of the reasons why I'm also here today in Beijing, because this is my first trip to Asia since taking on again my role at UBS, and I think it's very important for me to reach out to all the Chinese stakeholders and reiterate our commitment to China, while also updating them on the integration.
So I do know that here in China, UBS has a securities venture Credit Suisse also had a securities venture. It would seem to make sense to sell out of the Credit Suisse venture. Is that something you're pursuing now?
Well, we are currently evaluating the best options. Of course, we are not allowed to have two operations, but we need to really understand exactly how to do that. We are very happy with our historical operation here in China. That we were the first to get the license as a foreign investors to own a controlled stake. So it's a very important element of our strategy in China. And now we need to exactly evaluate how to integrate or what to do with the CS operation.
Sort of how far have you progressed in that process? Are you looking at potential buyers? Are you talking to anyone yet, or has it not gotten to that place?
At this stage, we are examining the situation.
Okay. In your second quarter results, it mentioned specifically that client confidence, sentiment, and activity here in Asia was muted. Are you still finding that's the case into the third quarter?
Well, I think that we saw in general a little pickup across the globe, also in Asia, in terms of client activity. The most important topic for us was to see the returns of assets that left Credit Suisse in Q4, Q1 this year. We started to see assets coming back at Credit Suisse towards the end of the second quarter. We see also very good momentum in Q3. So that's the most important issue. But also in general, it's fair to say that investors are more constructive than they have been recently.
So on the momentum you talked about in Q3, there was a net new money inflow of about $16 billion in 2Q. You said at the time you expected that to continue. What is it looking like in 3Q? What does good momentum mean?
Well, I mean, we are pursuing similar patterns, so we are not going to be specific on numbers. The quarter is still ongoing, but the most important issue is that we see substantially our forecast being confirmed, and we are getting to the close of the quarter. So I think that's very encouraging to see that so quickly our clients are responding to our actions to stabilize Credit Suisse and to offer them the best of the combined organizations.
And in Asia, I believe in the second quarter there was a net money inflow of about $1.8 or so billion in Asia. Do you see a similar sort of trajectory in the third quarter as well?
Yeah, we see positive trends across the globe in each region. Yeah.
What about here in China? What does the sentiment feel like? Not only here, but like globally, the perception of China and Chinese assets.
Well, look, in general, in the globe, we are going through very challenging times in terms of macroeconomic picture. Of course, the geopolitical tensions are not helping at this stage. But I do believe that many investors still see the long-term potential of China. It's exactly how to navigate the current situation that makes our job even more important. We are not only here in China, but also abroad, are helping clients to understand China, how to invest into China, and also for Chinese investors, how to invest abroad. So I think that we see this situation as an evolution, of almost natural evolution of things that happen over the last 10, 15 years. The macroeconomic, the geopolitical picture has changed completely, and this is part of the journey.
When your employees here in China, when regulators here in China, or clients, partners ask, do you have plans for more investment? What are your plans for China as part of the new UBS? How do you respond?
Well, we respond that we have been here in China for 30 years. We were one of the first to be in China and to make substantial investments, and is exactly the the reason for my visit is here to be to reiterate our commitment that we see China as an important driver for growth for us. Right now, we are very busy in integrating Credit Suisse. We are very busy in managing our current business, staying close to clients, but we are not losing sight of the opportunities that are still there to grow organically, both in the US, but also in Asia, and particularly here in China.
Recently, there was a Bank of America survey of global investors that identified Chinese property as the thing that people thought most likely could cause the next global credit event. Where does it rank for you in terms of risks?
Well, we know that almost any major crisis, if there is one, is triggered by either a real estate crisis or a government debt crisis. So I think it's quite clear that the situation in China is fragile around the real estate sectors. The government is taking actions to contain and to help manage this very difficult situations. But of course, if there is one part of the economy that is exposed to potential threat is the real estate sector.
Back to the integration of Credit Suisse. It's taken your headcount, your staffing, to about 120,000 globally. And you've talked about, pretty forthcoming about the need to reduce that number. How much of a reduction do you think is needed at the end of the day?
I never really spoke about the need of reducing headcount because it's not and it's not our philosophy. What we need to do is to restructure the bank. Credit Suisse needed to be restructured, profoundly restructured because out of this situation, and then we need to extract the synergies that are necessary to make both businesses viable and stronger. So we are taking actions as we speak to resize the business. We are also taking advantage of the fact that we had natural attrition that is helping across the globe. We have demographic trends helping in that sense, people exiting the bank through retirements or early retirements. We are working also in facilitating movements of people within the bank, also between the two banks as we speak. So I think that I'm comfortable that we can mitigate the painful part of the job, which is the social cost. But it's very necessary in order to create a business that is sustainable.
Okay, that of course was the UBS CEO Sergio Armati speaking to Bloomberg's John Liu in Beijing. A couple of lines crossing then from that interview just on his views around China. UBS has very limited direct China property exposure. Still sees, though, investors having positive views on China in the long term in terms of the potential there, and also addressing the question around those assets, of course, linked to Credit Suisse, saying that there has been some progress there, but almost impossible to get back all of those assets.
Really interesting that he makes this visit at all, isn't it? Because as John Liu was saying, was asking, trying to probe for his views on the opportunities in China. There's UBS recommitting to China, I suppose, by this visit, because this is a business that's really busy doing other things with the Credit Suisse integration. But he says there's still opportunities to grow, and some of that coming from the US, some of that in Asia, specifically in China. So that recommitment and that appearance in itself, news, I suppose.
Very diplomatic in his language, of course. He's absolutely right. They have been there 3+ decades, and they were one of the first banks to get licenses around securities business in China. So they're kind of ahead of the curve on that front. But clearly, it's a challenging operating environment. But as you say, points to the importance of that business for UBS going forward. Coming up, President Biden switching focus. We're going to focus on his visit to the auto workers, of course, on the picket line, showing presidential support for their workers and the union. Is that a thawing relationship, or is there a thawing relationship now between the unions and the US president? We're going to discuss that next. This is Bloomberg.
what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
City. From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
He's there to kind of upside.
We can and will go all out if our national leadership decides the companies aren't willing to move. Stellantis and GM in particular are going to need some serious pushing. All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike. We will be striking 38 locations across 20 states, across all 9 regions of the UAW.
UAW union president there, Sean Fain, talking about work still to be done on these strikes and conversations with manufacturers. Now, President Biden says he will travel to Michigan on Tuesday to support striking United Auto Workers union members. His announcement comes as GM and Stellantis are facing walkouts at 38 more facilities after talks last week failed. That's an incredible number of production locations. Let's get to Bloomberg's Oliver Crook, who can take us through the latest developments here, because this is being watched for the micro, what it does to the sector, but also for the macro, what this does to the US economy. A week passes then, Oliver. Where are we on these negotiations?
That's right. You saw there Sean Fain in sort of like military fatigues camo, really going out there to turn up the pressure on Friday, again, mostly against GM and Stellantis, and totally sparing Ford, saying that basically enough progress has been made there that they are content with that they're going to spare them. The question is, what actual progress has been made? We've got nothing in terms of the headline front in terms of the percentages for increases and that sort of thing. So what progress has been made with Ford? What we understand, it's an agreement on reinstating the cost of living increases, inflation protection for paychecks, which was suspended in 2009 after the restructuring of the auto sector, and also enhanced profit sharing. So that's where we think we've made some progress. However, Ford did come out, the one that's made the greatest amount of progress, saying there are still very complex and interconnected issues, and there's still significant gaps. If you look at what happened in Canada with the union there, they struck a deal with Ford, and they're going to take that model now to the other car companies. So in the U.S., they've taken on all big 3. They found an amenable one, go to perhaps the diminished 2, and maybe get an acceptable deal with the big 3.
What is the political dimension here then, Ollie, as we hear about Biden's proposed visit to go and meet union workers? How are the politics playing into this?
Yeah, I mean, as you know, we have an election in the United States just over a year from now, which in U.S. political time is basically no time at all. And so Biden saying, it was Sean Fain who called to him, said, hey, come stand with us. And Biden's going to stand in the picket line tomorrow. And this is sort of an event without really precedent in U.S. history. Another event that perhaps does not have a great deal of precedent is the leading Republican candidate skipping the debate in order to give a speech on Wednesday in Detroit to, again, speak to the auto workers and try to woo the blue-collar vote. It's about Michigan, yes. It's about Pennsylvania and Wisconsin. These are states that have flipped back and forth. They went to the Republicans in 2016 when Trump won. They went back to Biden in 2022 when he won. And Sean Fain, throughout this whole thing, has really tried to stay out of the politics. There's that statement they put out last week saying, quote, "We can't keep electing billionaires and millionaires that don't have any understanding of what it's like to live paycheck to paycheck and struggle to get by and expecting them to solve the problems of the working class."
Okay, so the political tension runs on. How long could this go on for then, Ollie, when you look at the extent of the strike activity and the demands being made?
Exactly. So let's look at one of the constraints, which is how much money there is in the UAW strike fund. So this is not really CPA level accounting, but it's sort of back of the envelope. They have $825 million in the fund. You get $500 a week per worker. You have 18,300 workers striking. That's about $9 million a week. That could mean you could go on for 90 weeks, right? So there's a lot of dry powder. And now they've only hit the not the assembly plants, the parts plants. There are still assembly plants for the Ford F-150s, the Silverados, the Rams, the real profit centers. They haven't hit those yet. And remember, even with the expanded strike, that's only 12% of the workforce, so you still have a huge amount of dry powder going into what may be still the early phases of the strike.
Okay, Bloomberg's Ollie Crook with the latest in terms of the strike, the politics, and just how long this all could run on for. But Ollie, thanks for the latest, joining us, of course, out of Berlin. Coming up, Amazon making another big push to boost its AI presence. We're going to have more on that $4 billion investment in Anthropic, what it could all mean for Amazon and the broader push into AI. That is next. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
Happy Monday, this is Markets Today. We are 53 minutes into the European trading day and you are flat across European equities, pairing some of the heavier losses at the start of the session. US futures pointing up around 0.4%. To technology now, and Amazon is investing and will be investing as much as $4 billion in the AI startup Anthropic, bagging a crucial partner in its effort to become a major player in generative AI. Let's get the context now with Bloomberg's Alex Webb. Alex, tell us about Anthropic. Tell us about how significant this deal, this investment is.
Yeah, Anthropic is an impressive company. It's got an impressive roster of founders who essentially were refugees from OpenAI. They left soon after the changes to OpenAI's essentially constitution. OpenAI was supposed to be open for the world. In the end, it started taking outside investment. So a bunch of them went and founded Anthropic, and it is a big player in the generative AI space, creating models that are very similar to ChatGPT.
Okay, so that's what it does. Why might Amazon need it then, Alex? What's Amazon looking to get out of this?
Amazon has very much been seen as a laggard in this space. You know, Google obviously got strong AI chops. Google Bard is their forward-facing like chat model. They also have Microsoft was the big competitor in cloud. They are very close to OpenAI, so they have got first dibs on a bunch of generative AI stuff. Amazon did not, and so this potentially beefs up their capabilities in that space, which helps them when it comes to the battle for the cloud.
Alex, what does it tell us about the business model for generative AI? I speak to some people in this space and they talk about just how much is needed to build out the compute to underpin these models. How is the business model changing in the way that these different companies are looking at it?
It increasingly looks like it is a sort of piece of technology that gets companies to build their products on your particular cloud. So if you're Amazon, now you have something to encourage a company to build on AWS, on Amazon Web Services. Google obviously has been using its AI stuff to get people to build on Google Cloud, and OpenAI gets people onto Microsoft Azure. That's where they make the money, right? On the cloud services, the processing cost of this stuff is high. You're not necessarily going to be paying directly for the language models, for the generative AI technology. You are paying for the compute that's needed to drive it, and that's where the likes of Amazon, Google, and Microsoft are looking to make money.
Okay, Alex, thanks very much. Bloomberg's Alex Webb with the latest on Amazon and what it's doing on the AI front. Really interesting. We'll get to the markets in a moment, Tom, but really interesting to see Amazon make this move. And it reminds me, just listening to Alex there, reminded me of some of the reporting and research I've been reading recently about whether companies decide to go to use the large language models and use very general applications around AI, or whether it's going to be about companies that create specific solutions for them using AI tools. There's a lot we don't understand perhaps about the way businesses are going to jump on this trend.
Well, and how investors position around that theme then, whether they do invest in those companies that are building out the products on top of the models or invest in the models themselves, is going to be really consequential as well in terms of the money flow around this space. Checking back on the markets then, for now, you're looking at European stocks currently just clinging on to the slimmest of gains, but it has been a turnaround in the session, hasn't it, Anna? And in terms of what's happening across the commodity space, because arguably that's where most of the interest has been, at least so far in the session, a divergent picture when it comes to iron ore prices versus oil.
Yeah, absolutely. Stocks really flat. Nothing much to see in terms of the European story. US futures do point higher, but as you say, commodities in focus. We've got iron ore down by 3.8%. Some concern around the Chinese growth story weighing on things there. That doesn't seem to be weighing on Brent. Actually, a lot of volatility in Brent, though, because just in the break when we were talking, the Brent price was up by more than 1%. Now, not up that much, but 94.08. So we see a lot of movement around these commodities this morning.
That is a focus for us this morning, and that is it for markets today. But of course, you can get insights from us and the team on the front page of the Bloomberg UK website, or by typing TLiveGo on the terminal. US futures pointing higher. The pulse is up next, and this is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, standing in for Francine Lacqua. Here's what's coming up on today's program. European stocks following Asian markets lower, all thanks to those renewed concerns in China's property sector. Meanwhile, some green on the screen in shares of SBB after the troubled Swedish landlord gets a $720 million cash injection from Brookfield Asset Management. Plus, the EU's trade chief warns Beijing that the bloc will be more forceful in upholding fair competition during his trip to China. That is your headlines. Let's get a quick check on the markets here and take a look at the European markets map, because already you are seeing a little bit of movement, but perhaps not the kind of movement that we actually want to see. A lot of micro moves is what I'm going to call them. The outperformer here is going to be the French index. Of course, you're seeing it higher by 0.1%, but the rest not moving much, which is interesting given that we are getting some German data as well. The September IFO Business Confidence Index coming in slightly hotter than what the estimate was at about 85.7. The estimate there at 85.2. When you look at their expectations index, I would call it right on par at about 82.9. The estimate there 83.0 as well. And of course, the current assessment index 88.7. The estimate 88. Now on the surface, it looks like some pretty inline data, but of course, we're going to get some real time analysis. We'll be speaking to the IFO Institute President Clemens Foist coming up at 9:20 a.m. London time. What does this all mean, though? Because, of course, the fear here is that do you start to see in these kind of micro pieces of data some sort of indication that Germany is, at the end of the day, going to be the sick man of Europe, dragging the rest of the continent and perhaps even the world with it? A lot of pressure on just one country. Let's see what the markets think. For more, joining me now is John Bilton, head of global multi-asset strategy over at JP Morgan Asset Management. John, pleasure to have you on the show.
Thank you.
Let's start with the data. What'd you make of it?
Well, you know, I think what it's demonstrating is that we've got some weakness going on, but you're getting to be towards something which is forming a bit of a base. I mean, the PMI data on Friday, showed Germany still in the depths of a contraction. So the issue I think that we've got is it starting to leak out more broadly in Europe, as you mentioned? There is some indication that France is starting to catch down to it. But I think what's interesting is over the course of this year, we haven't had that big sort of global slowdown that everyone came into the year expecting, because it's kind of like the baton's passed from place to place. So while I think there are some concerns around Europe in general, remember, inflation is now beginning to come down. The ECB are probably at peak rates. And at the same time, the US economy actually is looking as if it's hanging in there. So I think there's reasons to be perhaps seeing this more of a score draw than necessarily seeing it as being a big red flashing problem.
Well, the resilience is tricky here, right? Because I mean, you look at the U.S. economy, you arguably look at the European data as well. We were supposed to be in a recession on the continent, what, 2 years ago? That never happened. I might just be jinxing it. We'll see. If we turn to a recession this winter, it's all my fault. Let's talk a little bit about what's actually priced into the markets here, because it's really hard to find the trade that works late cycle in an economic cycle, right? And it feels like Europe specifically and Germany specifically has been in that standpoint for 2 years now. What's the trade here?
Well, I think there's, first and foremost, Europe did have a recession. Think about it. But, you know, Ireland and Germany, admittedly through technicalities in the data, took the Eurozone to the mildest of mild recessions over the course of the winter. So are we facing a situation where Europe gets pulled back down? And we think we'll see probably a couple of quarters of more or less zero growth. Could the Eurozone trip into recession? Possibly. I think right here, right now, it's more a question of waiting. What's kind of interesting, within Europe, a lot of the more defensive sectors, things like pharmaceuticals, other parts of the defensive complex, starting to look kind of interesting, particularly now that we think we're coming towards peak rates. If inflation starts to cool, ECB at peak rates, excuse me, lower long-term yields, potentially could give a bit of a boost to those defensive segments. It's not the same in the rest of the world, though. If you look at cyclicals versus defensives in the US, actually there's a little bit more support coming through for cyclicals, more scope for inventory restocking. So perhaps a more cyclical tilt in the Americas, maybe a more defensive tilt in Europe, gives you a little bit of juice there.
How quickly does that defensive tilt in Europe get even more severe, especially as we're looking really down the barrel at $100 oil? We're looking at a conflict in Ukraine that's getting truly worse and worse, impacting suddenly not just the oil supply, but the commodity supply as well. Natural gas was never a strong suit to begin with. Talk to us about how that thesis of resilience, the defensive play, falls apart.
Well, I think we've got to be a little bit careful what we look at. If we look at the headline price of Brent, yes, I mean, high oil prices, if they go streaking upwards, it's a tax on the consumer. But for Europe, the most important piece is the natural gas price. And yes, we've seen some upside in terms of the front end of the natural gas curve, but contracts for delivery later on actually haven't really moved. So you know, Europe's not facing the same very clear and present risk that it was this time of last year. So I think some of those fears can be taken away. Right now, we're facing a manufacturing sector in Europe which is going through a destocking cycle. Of course, very plausibly, companies decided to overstock in basic material, intermediate goods, etc., immediately after the invasion of Ukraine. And those inventories take some time to play down. And with a relatively lackluster consumer base in Europe at the moment, folks are very happy to sit on their excess savings, unlike their American counterparts. That means that you've got this lack of dynamism coming through in the economy. We think that the destocking cycle will play through, and at that point, actually, you'll have a relatively clean slate to play.
But you're saying that the European Union and European traders broadly have kind of priced in this idea of peak rates. How quickly does that thesis kind of collapse? Again, given the commodity story that we're talking about, yes, the idea here is that inflation has come down a little bit. Has it come down enough to say that it'll stay down, or are we still subject to fuel costs or utility costs, et cetera, which would then, the ripple effect there be simply that maybe the EU, maybe the ECB has to go even harder on inflation and turn that pricing in on its head?
Well, I think this is why we look at the difference between headline and core CPI. And of course, we've got the data coming through later this week. We think that the European Union will see, or the Eurozone will see the headline inflation come down below 5%. We also believe that if you take food and energy, yes, it can have a pass-through effect in terms of headline inflation. But again, I use that phrase, it's a tax on the consumer. If you've got a consumer who's squeezed and they're suddenly paying more for their household spending, more to heat their homes, more to drive their cars, they're spending less on other things. So I think when we face, as we've read many places, something of a cost of living squeeze, it can actually have a countervailing effect on core because of forcing consumers to make choices. So we think the ECB will look through it. It's worth noting that we had comments this morning from DeCoste suggesting that we need to have time for the impact of higher rates to really come through. So I think we're seeing a much more balanced ECB council now. Yes, you're going to get the hawks pointing at inflation, but more and more I think you're going to have the doves saying, you know what, maybe time to wait and see. We've gone from negative rates to 4%.
Yeah.
We haven't seen the full effect yet.
I mean, then it brings up a topic of just how long the lags really even apply here, which don't worry, I will not make you answer. A little bit of cringeworthy words, isn't that right? John Bilton, Head of Global Multi-Asset Strategy over at JP Morgan Asset Management. We thank you, as always, for your time and your insight. Coming up on the program, we bring you an exclusive conversation from UBS CEO Sergio Ermotti. Expect lines on the Credit Suisse, UBS integration, and of course, business in China. That conversation coming up next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Things are progressing very well. We made shift, very swift progress in integrating Credit Suisse. We closed the transaction in record times, also thanks to the big cooperation of regulators across the globe. And that's one of the reasons why I'm also here today in Beijing, because this is my first trip to Asia since taking on again my role at UBS, and I think it's very important for me to reach out to all the Chinese stakeholders and reiterate our commitment to China, while also updating them on the integration.
In your second quarter results, it mentioned specifically that client confidence, sentiment, and activity here in Asia was muted. Are you still finding that's the case into the third quarter?
Well, I think that we saw in general a little pickup in across the globe, also in Asia, in terms of client activity. The most important topic for us was to see the returns of assets that left Credit Suisse in Q4, Q1 this year. We started to see assets coming back at Credit Suisse towards the end of the second quarter. We see also very good momentum in Q3. So that's the most important issue. But also in general, it's fair to say that investors are more constructive than they have been recently.
So on the momentum you talked about in Q3, there was a net new money inflow of about $16 billion in 2Q. You said at the time you expected that to continue. What is it looking like in 3Q? What does good momentum mean?
Well, I mean, we are pursuing similar patterns, so we are not going to be specific on numbers. The quarter is still ongoing, but the most important issue is that we see substantially our forecast being confirmed, and we are getting to the close of the quarter. So I think that's very encouraging to see that so quickly our clients are responding to our actions to stabilize Credit Suisse and to offer them the best of the combined organizations.
It's taken your headcount, your staffing, to about 120,000 globally. And you've talked about, pretty forthcoming about the need to reduce that number. How much of a reduction do you think is needed at the end of the day?
I never really spoke about the need of reducing headcount because it's not it's not our philosophy. What we need to do is to restructure the bank. Credit Suisse needed to be restructured, profoundly restructured because out of this situation, and then we need to extract the synergies that are necessary to make both businesses viable and stronger. So we are taking actions as we speak to resize the business. We are also taking advantage of the fact that we had a natural attrition that is helping across the globe. We have demographic trends helping in that sense. People exiting the bank through retirements or early retirements. We are working also in facilitating movements of people within the bank, also between the two banks as we speak. So I think that I'm comfortable that we can mitigate the painful part of the job, which is the social cost. But it's very necessary in order to create a business that is sustainable.
UBS CEO Sergio Armati there, speaking exclusively to Bloomberg's Jean-Loup in Beijing. Now, sticking with European banks broadly, let's talk about Italian ones. Looks like Italian banks will be allowed to avoid paying a controversial windfall tax introduced last month if they set aside additional capital reserves. That's according to a government amendment seen by Bloomberg News. Joining me now is Bloomberg's Chiara Albanese. Chiara, pleasure to have you on the show. Talk to us about the logic behind this move.
The pleasure is all mine. So the logic is kind of a compromise that the government is doing with lenders and also within the coalition. The main message and decision that we need to keep in mind is that the government is still planning to get the same amount of money from the levy, so around 3 billion euros. So banks will be allowed to opt out if they put aside sufficient capital reserves, but the requirement is so high that we might expect only a few banks to do so, meaning that they will prefer to pay the tax itself.
Does this mean, I mean, from a market's perspective, there seems to be this thinking that this is going to somehow create the extra demand for BTPs, pull down the borrowing costs, and ultimately let Giorgia Meloni's government borrow at a smaller rate. Is that good news for the budget, or is this good news for Italian banks? Who benefits here?
So for sure, the budget is going to benefit from the tax. The state will have more money from the tax. But we need to keep in mind that this is going to be diluted over time. Banks will only pay in coming months. So in the meantime, the government will find different ways to finance its budget. At the same time, I also think that banks will live with it. They have factored the fact that they will have to pay this tax in. They will set aside more reserves. So the compromise is very political, and the news has been absorbed by the markets and by lenders.
Certainly something we're going to be keeping a very close eye on. You can already see slight outperformance with BTPs off this headline. We'll see if there's more market reaction to come. Chiara Albanese joining us this morning. We thank you as always. Coming up, Germany's business confidence index fell less than economists expected in September. The IFO Institute president joins us to discuss the latest German economic data and more. That's coming up next. This is Bloomberg.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
Conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Let's recap some of the data we got from the top of the hour. Germany's business confidence index fell less than economists expected in September. Joining us now for more is IFO Institute President Clemens Foist, joining us from Munich. Clemens, a pleasure to have you on the show. Thank you so much for joining us this morning. Let's start with a very simple question. The data came in kind of tepid, kind of lukewarm. Where are the indications that perhaps Germany is falling apart?
Well, I guess it's not falling apart, but it's not stabilizing. The German economy has difficulty leaving this downturn or stagnation, whatever you call it. So what we see in the data is a mixed bag. Companies are saying the current business situation is getting slightly worse, but they expect things to improve a little in the months to come. So it's not much change, but saying, like some people do, that the German economy falls apart is also an exaggeration.
So perhaps not falls apart, but weakness, as you just pointed out yourself, something you're seeing around the rest of the world. What kind of timeline does that mean for the rest of Europe? Is this something people should be watching as that Germany is the sixth man of Europe and will drag the rest of the continent, or is that an exaggeration?
Well, I think it's an exaggeration. We expect the economy to stabilize next year. At the same time, yes, I think what Europe needs to watch is that the outlook for potential growth for the coming year is lower. And that is related, of course, to demographic change, declining labor force. It's related to the particular path of energy policy Germany is taking. Its decarbonization strategy is extreme in the sense that it has switched off nuclear. It has an approach to decarbonization which is very regulatory. There is detailed regulation, a lot of bureaucracy, and this approach seems to be failing. Companies are telling us they face a lot of uncertainty, and it's policy uncertainty in Germany. And this is not good in a situation where the economy faces headwinds anyway. High energy prices, the energy-intensive industry is leaving. So there is a lot of substance in the German economy, but the government needs to make an effort to use that substance properly.
What does that then mean in terms of the bright spots here? Are there any when it comes to the German economy?
Well, the bright spot in the short term is probably that disposable incomes, that wages are stabilizing. So there have been some fiscal policy measures to raise net wages, some tax breaks, so that we expect consumer demand to stabilize in the coming months. That's because wages are rising and prices are coming down. Inflation rates are declining, so that will lead to a stabilization of consumption demand. And of course, in a world with high inflation and stagnating GDP, one might say demand is not what's lacking. But what we do see and what companies do tell us is that we are in a transition towards problems coming from the demand side. So the bright spot is a certain stabilization of demand, and with prices stabilizing, also the perspective that the ECB may not raise rates further. That will also have a stabilizing effect.
Well, it's no secret. I mean, it's Europe 101 to know that Germany is and has been for some time kind of the beating heart of Europe in terms of economic growth. Talk to us a little bit about just how sustainable that actually is. I mean, if you look at the German economy, there are cracks, there are structural issues as well. To what extent can Germany have that reputation, for lack of a better term, continue into the next decade or two?
I would say it's unlikely to continue into the next decade. Potential growth will be lower. The demographics are one reason. I mean, this will also affect other countries in Europe. So it's a problem for Europe as a whole. And then there are particular issues in Germany. The energy-intensive industry, the chemical industry, the paper industry, these are industries that are currently making plans to leave Germany. The car industry is in a difficult structural transition, probably the most important sector in Germany. A lot will depend on government policies in that context. Government policies have created a lot of uncertainty for companies. There is a lot of bureaucracy, and the question is, does the government manage to turn this around, take a different path? If it does, I think there is potential
certainly something
in Germany.
We're going to be watching very, very closely. And Clemens, we're going to have you back on soon. We're sadly pressed for time, but we, of course, will be speaking with you soon. President Clemens Voice of the IFO Institute, thank you, as always, for joining us this morning. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
European stocks follow Asian markets lower over renewed concerns in China's property sector. Meanwhile, some green on the screen in SBB, shares surging after the troubled Swedish landlord gets a $720 million cash injection from Brookfield Asset Management. Plus, the EU's trade chief warning Beijing that the bloc will be more forceful in upholding fair competition during his trip to China. Good morning and welcome to The Pulse. I'm Kriti Gupta in London, filling in for Francine Lacqua. Let's go to one of the major market movers of the morning. Shares of Swedish landlord SBB surging this morning, higher by almost over 25%. The company has agreed to sell a 1.16% holding in the education division to Brookfield, a deal that would get SBB $720 million of a cash injection, an extension of a lifeline, if you will. Joining us now with details, Bloomberg Stockholm Bureau Chief Charles Daly joins us this morning. Charles, what do we know? How much does this prolong some of the issues that SBB has had?
Yes, hi, good morning from Stockholm. The cash injection basically covers SBB's short-term funding needs for the next 12 months. And as a consequence of that, we're seeing bonds also rally in the market today as well, alongside the shares.
What does that then mean in terms of kind of the broader real estate space? One of the concerns from a macroeconomic point of view is that even though this feels idiosyncratic to Sweden, perhaps it might be kind of the canary in the coal mine for the rest of Europe. Is this the kind of moment where SBB's worries are over?
No, I think it's very premature to make that conclusion. I think with a debt pile of nearly $8 billion, there is still a lot for this company to do, be it further asset sales, further equity partnerships, or even an IPO of one of its divisions. And I think in the current climate around real estate and the concerns that investors have, all of those objectives will be very difficult to achieve.
A fascinating story, I think, and again, one that has really macroeconomic ramifications for the rest of the continent. Bloomberg's Charles Daly joining us from Stockholm. We thank you as always. Now, at the core of this kind of property story, the housing story, is going to be, in the case of a recession, who gets hit first? And of course, we have seen this resilience show up around the world in the higher income, the higher wealth brackets of specifically Europe. And if you start to see that case for recession, that this property sector woes getting even worse, who gets hit first? Well, it's going to be the higher income anyway, which brings me to the first sector that gets hit as well, and that, of course, is luxury. Who better to talk about it than our next guest, Rashid Mohammed Rashid, the chairman of Valentino and the founder and chairman of Alsara Investment Group, joins me right here on our Bloomberg TV studio. It's a pleasure to have you here right in person.
Thank you very much.
Let's talk with the macro here first. The future of luxury. We've seen this resilience, a lot of money, of course, coming in from China, from the Middle East. How long does that last?
Well, the reality, it have been, for the last few years, very resilient. I think last year, 2022, have been an exceptional year post the pandemic. We have seen luxury goods grow by 12 to 20%, depending how you treat the currency. But we came into 2023 with a prediction that luxury will probably grow 10%. We are seeing very strong signs that it will be much worse than what we expected. We have a number of factors at the moment which are impacting the market in a negative way. The American market is slowing down due to the reality that department stores are really in a suffering situation at the moment, plus the reality that spending is slowing down. The expectation that China will come into the market in a big way after the closure that they have suffered from in the last 2 years is not happening.
Yeah.
For many reasons people are aware of in terms of China and the economy inside of China. Despite the reality that Europe is still receiving a lot of tourists, but I think the spending of tourists is now becoming different. With the hike in the prices of airline and hotels, they are putting more money in experience and buying, yeah. So all in all, we are going definitely to see in 23 a market which is less than 10% of growth. Yeah.
Well, that's really leading to your point about the slowdown you're seeing in luxury around the world, to consolidation with a lot of the American luxury names. We just had this major deal as well, I think, between Tapestry, another more consolidation between the parent companies, Kate Spade, Stuart Weitzman, et cetera. Is that a similar logic when it comes to the recent about 30% stake that Kering had taken in Valentino? Is it coming off of these worries?
Well, not exactly, because Mayhoola, the investor of Valentino, has the intention to be a long-term player in the luxury market. And it is very clear, as you said, that there is a trend towards consolidation because bigger and bigger companies are having much bigger influence at the moment. The reality, of course, is that this deal is going to open the door to both companies, Kering and Mayhoola, in a way that they can play a much bigger role in the future of luxury in the coming years. And I think for Mayhoola and for Valentino, we have achieved a significant growth through the last 10 years, but this is hopefully will continue for the next 10 years also in a different way, and we will be more and more a player in the luxury market. Yeah.
Well, Mayhoola, as you said, wants to have this kind of long-term presence in the luxury market. Do you then foresee some sort of investment going into Kering, going into Balmain, which you are the chairman of as well? Where is their next target, in your opinion?
Well, I think it is very clear that initially we wanted to have an IPO with Valentino because the intention of the IPO was to achieve a number of positive points. One is really to have more institutional arrangement in the company, attract even better talents, but at the same time it was really an ability to grow and become a much bigger group. With the arrangement that we have at the moment through the deal that we have with Kering, that could happen by joining hands with Kering. And there is definitely an agreement that Mayhoola could and will become a shareholder in Kering in the long term. Of course, you know, Kering is very much a success story in development of the luxury in the last 2 decades. Yeah. They have done a fantastic job. They have amazing brands. They have a fantastic vision. They have a very, very strong leadership and a group. And I think Mayhoola will be very proud to join hands with them. Yeah.
So let's talk about this from the perspective of Kering here.
Yes.
Do you see them taking on an even bigger stake in Valentino? They, of course, have the option to do that until 2028.
Yes. Well, that's the intention. And in the meantime, we are going to have the time to discuss and to explore and to negotiate together even further investment between the two groups here. So the intention really is to get more integrated together, but at the same time to expand the horizon of the luxury investment. Yeah.
So when you say the idea is to create this partnership and to expand to it, are we ultimately talking about a full takeover of Valentino down the line?
Well, it's possible because at the end of the day, it's a situation that is mutual because we also have the possibility of acquiring more shares in Kering, which is something that we put it very clearly in the agreement that we had between the two groups here.
Talk to us a little bit about who else they might partner with, for example. There's some speculation that perhaps Kering should partner with Richemont, of course, the parent company of Cartier as well. Do you see that happening?
Well, I know that Kering is a very, as I said, they have a vision, they have an intention to expand. I think the wish of Kering to join hands with Mayhoola into Valentino was a very clear indication of where they want to go, because Valentino is today one of the most influential and the most prestigious brands existing to be able to grow in the future. What we have done with the brand in the last 10 years is amazing. I mean, we acquired the brands in 2012. It was almost less than 300 million. Today is 1.4 billion. It's really represent, you know, the ultimate luxury of what haute couture and Italy can present.
Yeah.
This is attractive for Kering, and this is the kind really of expansion that they want to build for the future. When it comes to bigger acquisitions as the one that you have mentioned, I mean, this is really something up to Kering what they want to decide. But I think a lot is happening in the luxury market because we have seen, as you said, growth over the 20 years, which have made this market one of the most attractive in the world. Yeah.
But you're being humble. Look, you're an expert in this stuff. You are an expert in the luxury business. We, of course, know it's Kering's decision. In your view, does it make strategic sense to have a partnership between a behemoth like Kering and Richemont?
Well, I think, you know, this kind of mergers of any big identities, you can not only take, you know, the numbers and the brands and look at it. I think there is another element in the equation, which is a culture. And I think this is really up to the management of both groups to decide if this is something that will fit or it will not be the right fit for them in the future, yeah.
So talk to us then about the Balmain piece of this equation.
Yes.
If you start to see ultimately a potential full takeover of Valentino from Kering, where does Balmain stand in that equation?
Well, Mayhoola has a number of investments. We have Valentino, we have Balmain, we have Palzeleri, we have Bayman in Turkey. These are 4 big assets, and they're all behaving in a very successful way and growing. And we will continue to grow, and we will continue to have a much deeper involvement in the luxury factor, luxury market. For that reason, I think Balmain will continue to grow. We acquired Balmain as a very, very special French brand, which is almost 75 years old, have a very, very distinctive DNA. It is a brand that is growing in many markets, especially in the United States and China at the moment. And we will continue to grow that brand to a much, much more influential place in fashion, yeah.
Lately, after its, I believe, debut in I want to say Milan, it dealt with a major robbery. What can you tell us about what was taken, where you expect those goods to go? Any insight you can give?
Well, this was in preparation for the fashion show that will be in Paris the day after tomorrow. And unfortunately, a robbery happened, moving, some of the pieces of the fashion presentation. But luckily, we have an amazing team of people who have been able to reproduce it. What it will happen with these pieces? Well, I don't know. I mean, some people might be very, very obsessed about having, Balmain pieces to the extent that they want to rob them. Yeah.
But what does, if you could put a number on the loss, what is that?
Well, it's probably 25% of the collection, yeah. But it have been reproduced, yeah.
A lot to digest, and you've hit it all. A pleasure to have you on the program. We thank you as always. Rashid Mohammed Rashid, the Al Sara Investment Group founder and chairman of both Valentino and Balmain, joining the program. Coming up, we take a look at LanzaTech Global, the carbon recycling tech firm. We'll discuss the challenges around capturing carbon emissions and more. Stick with us. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
the conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. LanzaTech is a carbon recycling company transforming waste carbon into sustainable raw materials for everyday products. By partnering with companies across the global supply chain like Zara, H&M, and Coty, just to name a few, LanzaTech is trying to pave the way for a more circular carbon economy. But the company's share price has struggled against the economic headwinds this year, down around 40%. Joining me now is LanzaTech Global CEO, Dr. Jennifer Holmgren. A pleasure to have you on the show and meet you in person. Let's talk a little bit about the costs associated with something like this. Look, it's a noble cause. Everyone wants to recycle on a scale that you were talking about. But in terms of growth for your company, how much is this going to cost?
Fundamentally, what we do is we capture carbon and make products, which means that the people that have a burden and a cost to reducing their carbon emissions actually can have a profit center. So the cost might be high now, but they're coming down quickly. And like I said, it becomes a profit center rather than a loss leader.
Talk to us a little bit then about plans for scaling up.
So our technology is already commercial. By the end of this year, we will have 6 commercially operating plants in China, India, and in Europe. And we just need to get ourselves to the exponential growth, kind of like solar, right?
Yeah.
Everybody's always wondering, when is it going to emerge? We're at that exponential growth stage. So I do expect to go faster, and 6 of our plants are going to prevent 500,000 tons of CO2 from being emitted. So that's a pretty big deal already.
Well, let's use the example of solar that you so beautifully laid out. I mean, one of the ramp-ups in solar, specifically in 2020 after COVID, everyone was saying, look, oil companies are dead, traditional energy is dead, we're going to go to renewable. And you did see the active investment in solar and wind, even in hydro. The problem with that is when people kind of hit scale and it became too much. If you have excess solar energy, what do you do with it? And that infrastructure at the time hadn't existed, and it created kind of an investor exodus that came just as quickly as the inflows did. Do you foresee that happening with your kind of technology?
Actually, no, because what we do is we're making everyday products, right? So we can make sustainable aviation fuel. The world uses 100 billion gallons a year, and we currently, globally, not us, global economy has 30 million gallons. So the gap is massive right now. The same thing with, we're converting our ethanol to things like polyester for clothing, you know, Zara, H&M Move. Craghoppers has a fleece out right now that uses our technology. I don't think we're going to run out of places to put it, to put our product, not at all.
Talk to us a little bit about just how global your market actually is. You mentioned H&M, Zara, Coty, et cetera. Where are you expanding?
Right now, one of the biggest places for us is India. There's a lot of interest in India. I think you know that Prime Minister Modi just announced at the G20 the Global Biofuels Alliance, and we think India is a great market for us, and we're making a lot of progress. Our partner, Indian Oil, just started up our plant that uses their refinery off-gases to make ethanol. So, yeah, that's going to be a great place for us.
How much fiscal support do you have from India, though? Because one of the, from my understanding, one of the hesitations to invest in India is just how much hesitance there is to bring foreign companies, specifically American companies, into India's kind of ecosystem. You've seen that with IKEA, not that that's an American company, but IKEA was a great example of that. How much support do you have from the government?
So we're a licensing company. So we license our technology to companies that have the balance sheet to build our plants, like Indian Oil. And they, of course, partner with their own governments. So we don't have to get in the middle of that. And there is a lot of government support with incentives and also infrastructure building.
Yeah.
But really our partners, who really are big gorillas, right? Indian Oil, you're not going to do better than Indian Oil in India, are really the key to helping us be successful.
Yeah, well, let's get some updates, if I can, really quickly on major projects coming from your company, specifically LanzaJet. And I believe there's a production facility, your first, in Georgia, I want to say. Talk to us a little bit about the timeline here. It's scheduled to come online. Are you on track for that? What does that look like?
Absolutely. So that's going to produce 10 million gallons of sustainable aviation fuel per year. It will be mechanically complete by the end of this year, and it is on track for that. And you know, that's a really nice opportunity, right? Soperton is a small county in Georgia.
Yeah.
And so by building this plant there, we're creating jobs in that rural economy. So yeah, it's going quite well.
And then an update as well on the status of Project Dragon, which I've got to say is a pretty cool name. I'm very excited to see that on T-shirts and hats. That I believe is your first commercial scale facility in Wales.
That's right.
Talk to us about the update there.
Yeah, so actually we just did our permitting application, and we've done the comments for the permitting. So we've made quite a bit of progress on the engineering. That's receiving some funding actually from the UK's Department of Transport, and that's massively helpful in getting the project moved quickly. Yeah, that's also progressing. I expect there'll be another 2 years though till that is up and running.
Another 2 years from right now, so 2025. Whereas I believe it was planned for 2027. So you're actually ahead of schedule. Is that right?
The alcohol to jet plant, the sustainable aviation fuel, should be end of 2025.
Wow.
Yeah.
Okay, so ahead of schedule then. We appreciate your time as always. That's just a crucial conversation in the transition to green technologies. Dr. Jennifer Holmgren, LanzaTech's global CEO, joined me right here on set. Thank you as always. Coming up on the program, the EU warns China it will be more forceful in upholding fair competition and defending its interests. We're live in Brussels next with the details. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
A quick check on the markets here because you are seeing some movement. Suddenly, you are starting to see U.S. futures really get on the same page as what you saw in the rest of the world. Remember, we really started off with sour sentiment in Asia, a lot of those property concerns out of China coming into the European indexes as well. The Stoxx Europe 600 has only worsened when it comes to the sell-off, down about 0.8%. And now you're seeing the same thing feed into U.S. futures as well, down about 0.2%, which again is a recent development. A lot of that movement coming from that German IFO index as well. The strength that you are seeing, though, is from the Bloomberg dollar, higher by 0.2%, and even yields in the 10-year seeing a little bit of a sell-off in the bond market as well. So again, a defensive play, at least when it comes to the FX space, that seems to be the story there. So certainly something we're going to be keeping an eye on very, very closely. Now to one of the major stories here. The EU's chief trade negotiator warned China during his trip to the nation that the bloc would be more forceful in upholding fair competition and defending its interests. Joining me now is Bloomberg's Maria Tadeo. She is all over that story. Maria, we're talking about imbalances. What does the EU actually want from this trip?
Yes, Kriti, and we have Valdis Dombrovskis in China. He's on an official trip there. Remember, he's the head of the trade portfolio, as you say, for the European Union. This is a crucial portfolio for the EU when you look at just the size, but really the magnitude of the single market. And Dombrovskis is going there with a couple messages. In fact, one is obviously no decouple, but yes to de-risking. He also says the European Union does not want to cut off economic relations with China, but as you say, they have to be balanced out. To me, there's also a quote that's very striking. He says at this point, China and the European Union find each other at a crossroad, and it is up to China to figure out where this relationship goes, either balanced out or the two will have to move further away. Let's take a look.
We stand at a crossroads. We can choose a path towards mutually beneficial relations, one which is based on open, fair trade and investment, and working hand in hand on the great challenges of our time. Or we can choose a path that slowly moves us apart, where the shared benefits we enjoyed in recent decades weaken and fade, and as a result, where our people and economies face reduced benefits.
And that was Valdis Dombrovskis, trade boss for the European Union. And you heard it there, Kriti, really striking language, saying either we recalibrate or we will have to move further apart from each other. A lot of this obviously is underpinned by that massive trade deficit, 400 billion euros in favor of China.
Certainly something I know Maria will be all over tomorrow. We thank you, as always, for the update in the program. Up next on TV, Bloomberg Brief with Danny Berger in London and Manus Cranny in New York. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Fresh signs of concern in China. The property sector delivers a blow to risk this morning, and global risk appetite shifts. Wall Street's picking up the pieces as the higher for longer mantra sinks in and stocks flash a recession warning. Some signs of hope elsewhere. The U.S. Transportation Secretary says UAW and Big Three car makers can strike a win-win deal. Meanwhile, the end of the Hollywood strike, it could be near. A very good morning to you. We've just shifted gears quite dramatically in the past 30 minutes. What happened? The world began to look at China and a third of a billion. That is a third of $1 trillion, $327 billion worth of debt, which is mounting at Evergrande and a liquidation risk. You were told it was supposed to be contained in China. It's shifting out to a global week of risk off. S&Ps were down 3% last week, NASDAQ down 3.3%. And there's something else going on in the underbelly of the market. We have industrials flashing a recession. Yes, that word is back in the form of a market narrative. Industrials down 8% from the peak. Russell 2000 down 11% from their peak. And money is gushing out of stocks at a global level. $17 billion walked out the door of equity risk last week. The NASDAQ continues lower this morning. Higher for longer is the real sort of narrative here. And Europe is under pressure. The miners are at the bottom of your screen. The reason why we have that, they're down 2.3%, is because of the Evergrande debt woes, Danny, and that's the bottom line. We're looking at one of the worst weeks for markets in equities since the SVB crisis. And this morning, yes, it may well be contained in China, but Evergrande risk is pervasive, it's live, and it's crossing borders.
Manus, that's why oil is so interesting this morning, because even though all the other commodities are getting trashed this morning on the fears of the property crisis in China, oil is still marching higher. Brent crude trading at just under $94 a barrel, up 0.6%. Perhaps it is the U.S. stockpiles that have collapsed. We've also heard warnings from J.P. Morgan saying an oil super cycle is on its way, saying we're heading to $100 a barrel. Or it could also be those hedge funds turning sentiment, boosting their bullish WTI positions by the most since February of 2022. Either way, no cracks there despite the China narrative. Now, the euro, a lot of cracks here. 10 weeks in a row. 10 weeks in the row, the euro has weakened versus the dollar. That is the worst run since the common currency was created about 20 years ago. So we are looking at also hedge funds at the same time. They're also getting more bearish on the currency. They've boosted their bearish positions to the most extreme level in about a year's time. Meanwhile, the 10-year yield, that is also climbing higher, 5 basis points. It's duration that has been under pressure. We had a little bit of buying last week, but the curve steepening is still in. Manis, that trade is very apparent, and it's coming at a time that, sure, the economy seems like it's been able to handle those higher rates, but we're about to have a quadruple whammy of potential shocks that are fully out of the Fed's control, be it oil, be it loans, be it strikes, be it at the same time China and a shutdown. Okay, that's 5, a little bit more there, Manis. But there's a lot here to contend with at the same time, you're seeing some corners of this equity market whispering about a recession.
And it is whispering, or it's beginning to howl a little bit louder. I like the way you frame those risks. They're not exogenous risks, they're known knowns rather than unknown knowns, to channel the ever-famous Rumsfeld. But looking at your yields, Danny, the question is this. You've got Bank of America saying yields can march higher to 4.75%. Ben Amons makes the point that whilst you're at 15-year highs, you're still 75 basis points away from the maxed out levels of 2006 and 2007. And that yields, in his view, Ben Amons at Medley Global Advisors, yields are too low for the extra duration risk. So again, Danny, we've got the recession on one side, which could take these yields lower, with that other concern about duration risk. Good morning from New York.
Good morning from London, Manis. I mean, hopefully it will be a good morning, but as you pointed out, we had everything turn, stocks turn pretty quickly. Now, there are those fresh signs of debt woes coming from the Chinese property developers. Let's get into a little bit more, because China Evergrande Group certainly running out of time to get back on track with its restructuring plan. We have concerns mounting. The latest setbacks included a last-minute cancellation of credit meetings and detention of money management unit staff. Raises the risk, all of that, of liquidation. The developer's restructuring plan would be one of China's biggest ever. Now, this is happening as stocks in that sector fell more than 6%, marking its worst session in 9 months. Now, joining us on this risk is Klaus Bader, Global Chief Economist at Societe Generale. Klaus, always such a pleasure to see you. Thank you for coming in. Look, at what point do you look at this housing crisis and say, despite the stimulus China has injected, this will overshadow it all?
Well, I think that's already happening, but you know, I think what really the key risk is there going to be an implosion, i.e., a financial implosion? You know, what people, okay, I was at Lehman for 10 years, a Lehman moment, and I don't think that that's going to happen, because you must not forget that basically the entire financial sector in China is government-owned. But the fact is that the Chinese government has been, you know, it's been, I think I saw in your service, there was a very good headline, which was no bazooka, but lots of pistols.
Yes.
And that's exactly what the Chinese government has done. It's kind of a piecemeal attempt at stabilizing the economy and stabilizing the housing sector. I think the housing sector, you know, can be stabilized. What I'm much more concerned about is, will you be able in China to rebuild confidence in the private sector? And that, I think, is the much bigger challenge.
Klaus, good morning. You stole my line, no bazooka, but many pistols. And of course, we've seen incremental moves from the triple Rs, a couple of triple Rs. Another one will come live now, or has just gone live, I should say. So you feel confident that this risk is contained, the Chinese can handle it, so there's absolutely no global reverberation? Or where does the shoe fall on the reverberation as a result of the implosion in the housing market?
Well, you know, I certainly wouldn't agree with that there are absolutely no reverberations. You know, the Chinese economy is going to grow a lot less quickly than it has in, you know, the last years. In particular pre-COVID. And I don't think that that's going to change. And that, of course, affects not only direct sales of companies to China, but also, you know, indirectly, i.e., you know, suppliers to companies in Germany, to Japan, for whom China is a very important market. You know, those are all affected. So I wouldn't say that there's absolutely no risk. You know, the great Chinese growth story is over, and I think that it has several elements. One, of course, is the demographics, and the other one is also that I fear that the Chinese growth model has been broken, and so far no one has come up with a new model. But the Chinese economy has been, you know, driven very substantially by the housing sector, and that's unlikely to come back.
Will a new model arrive, especially when you have, you know, Xi Jinping really talk about not wanting the excess of Western stimulus?
Well, that's right. And of course, he's very critical about welfare, what he calls welfareism, because unusually for a socialist leader, he fears that it's going to breed lazy people. So I'm not sure that there is a new model. You know, Xi Jinping, clearly his line is, the party controls everything. And the party is present in all companies. And I think that's problematic because, you know, no growth model lasts forever. That's obvious. I mean, in the 50s and 60s, the CIA was regularly predicting when the Soviet economy was going to be bigger than the US economy. And of course, people have been speculating when is the Chinese economy going to be bigger than the US economy. And I don't think it's going to happen because the model of, you know, industrialization and housing driven, you can't do that forever, particularly not when your population is shrinking.
But Klaus, you reflect and you say it is about patching up the housing market, delivering some kind of confidence again to the consumer. My question to you is, these, no bazookas, but pistols, will they deliver the confidence that you need in the consumer versus perhaps the helicopter money and the consequences of that in the G10 nations? How do they deliver consumer confidence? What is the policy function that will deliver that to steady this situation?
Well, I think the stabilization of the housing market, you know, housing, of course, is a huge part of Chinese households' wealth. And Chinese households save a lot because they have to save a lot because the whole social system, the healthcare system is, you know, very poor. And housing, Chinese households have a limited ability to invest abroad because they're capital controls. And so housing has really been the go-to asset. Now, I think how you put it, I think, is a little bit dramatic. I just read this morning about the absolutely meteoric growth in travel that's going to happen over the next couple of weeks when the Chinese Mid-Autumn Festival coincides with National Day. So there's a lot of travel. So it's not as if, you know, Chinese consumers are absolutely, you know, buckled up. And our view is that the worst in terms of economic growth for China is behind us, but it's going to be a very moderate growth path and incomparable to what it was.
Klaus, Manus and I are never dramatic. Never. We're always very sensible.
I'm just trying to get you to rise to the rise to the occasion, Klaus.
He does that. He does that. He pushes you, you know? He's not an easy one. All right, Klaus, stay with us.
Okay.
Much more to cover. SocGen's Klaus Botter there. All right, coming up, U.S. Transportation Secretary, Pete Buttigieg, is standing up for American auto workers as the UAE strikes drag on. We're going to have more on that. And we're going to bring you our exclusive interview with UBS CEO Sergio Armati later this hour. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
He is proud of being the most pro-union, pro-worker president, not only compared to the Trump administration with its anti-union policies, but really compared to any modern president. You're not going to find somebody who has more consistently stood with unions. Now, having said that, it's also the case that these auto companies can thrive in a win-win deal that does what the president has called for, which is to say that record profits should lead to record pay and record benefits for the workers who are creating all that value.
That was the U.S. Transportation Secretary Pete Buttigieg speaking on CNN's State of the Union. That was Sunday. President Biden says today he will travel to Michigan to support the striking United Auto Workers Union. Tomorrow, excuse me. Joining us now is Oliver Crook. So this is a huge, well, actually, you put it in context. You're American, I'm Irish. I don't really have an opinion. Is it a huge political gamble for Biden to go and join the picket lines?
Well, it's an interesting situation, and it's a situation that doesn't have a huge amount of precedent in U.S. history, with the president going and saying he's going to join the picket line, right? This is something that we don't tend to see, and as you know, the election is next year, and in U.S. political time, that is basically no time at all. But it comes also with another unprecedented act, which is on Wednesday, Trump is skipping the Republican debate to give his own speech in Detroit, both of which are really trying to woo the workers here. But just to get the latest on the strike, we had talks through the weekend going, and really no concrete progress in terms of the headline, in terms of the number on the raises. What's interesting is that Ford was spared the expansion of the strike. Why was Ford spared? The reason is they say they've made progress on a couple of things. One, reinstating the cost of living adjustment, the increases that were scrapped in 2009 when they restructured the auto industry. This is inflation protection for the paycheck, but also the right to strike and also the enhanced profit sharing. So this is where they're rewarding Ford for having made progress in these talks, but there's still a huge amount to go, and there's a lot of dry powder. Sean Fain has only 12% of the union striking right now. They have not hit the pickup truck assembly plants, which is really where, if they want to make it hurt, they'll start to focus next.
Oliver, thank you so much. That's Bloomberg's Oliver Crook. Now, in other strike news over in Hollywood, screenwriters have reached a tentative deal with studios that include Disney and Netflix. And in a strange twist of fate, The American is now going to ask a Brit about this. Joining us now is Bloomberg's Alex Webb. But we all watch Hollywood, so we all feel the significance about this. Is this success? Is this strikes over yet?
Well, it certainly looks as though we're getting very close to it. The members of the union will still have to vote on whether they agree with the terms that are being put forward. The assumption is that they probably will. We don't yet, however, fully know the details. The union have said that they think they've made good progress and they're happy with the deal. So when we have the details of it in a few days' time, then we'll be better able to gauge the temperature of the writers themselves.
Okay, well, they've certainly been on strike for, more than 140 days now. Alex, thank you very much. Alex Webb with the very latest on the Hollywood strikes. Meanwhile, you've got Congress heading into a make-or-break week for avoiding the government shutdown. Leaders of the Republican-controlled House, they're hoping that they can persuade the GOP holdouts to get on board with 4 full-year bills and a short-term funding patch. Shutdown is set for October the 1st unless Congress acts. And if no deal is reached, hundreds of thousands of federal workers are set to be furloughed. Klaus Bader is the global chief economist at Societe Generale, our guest this morning, setting the tone. Danny talked about a number of risks. None of them are exogenous. But on a scale of tail risk, a government shutdown, how do we need to look at it if it happens, if it's short, fast and furious, or if it's dragged out? What is my risk with the government shutdown, Klaus?
Well, that it is a reflection of the political process in the U.S. Being stuck and being rather dysfunctional. I mean, in the past, shutdowns have not tended to have an enormous impact on the economy. People are just furloughed. They eventually get their money, but with a delay. So I don't think it's a huge risk. There is, of course, a way out. Even if the holdouts in the GOP refuse to play ball, there's always the chance of a bipartisan deal, although that might very well mean that the Speaker of the House gets thrown out by his own party. It's just all part of this dysfunctionality of Congress and in particular of the GOP.
You previously have said that you're concerned about a U.S. default when we had the debt ceiling problem last time. How acute is that concern for you now? Is it still simmering in the background?
Absolutely, it's simmering in the background. And my concern with the inability of getting these funding bills through is only raised. And my concerns are only raised by this imminent risk that the Speaker of the House is under constant threat to be fired by his own party. So I think that risk is very much there. And what we're finding is that the resistance and the intransigence of a few people who can really hold up the whole process is becoming greater, rather than that there's an increasing degree of willingness to make compromises. So I am still concerned about that. Now, not in the immediate future, because it's not on the agenda in the immediate future, but I think it's a risk that doesn't go away. And as I've said before, I think the debt ceiling makes absolutely no sense. Congress agrees to spending bills, and they should finance it and not have a separate vote on whether there's a debt limit or not. I think it's an institutional flaw that shouldn't be there.
Well, it's a long old haul in politics, isn't it, Klaus? One thing is nothing's for sure, but we should get the PCE deflator on Friday, and we're expecting that to dip below 4% for the first time in 2 years. How close are you, as a global economist, to saying, look, we are at or near mission accomplished, or what would it take for the Fed to go for the extra hike? What data do you want to see to confirm no hike for the rest of 2023?
Well, I think it's first and foremost about inflation. But as I've said before, it's the low-hanging fruit has been picked as far as the fight of inflation is concerned. Now, the Fed looks more at core inflation. We'll see how that develops. The U.S. is actually, compared to a lot of other economies, in a slightly better situation, because in the most recent past, labor productivity in the U.S. has suddenly accelerated, and therefore unit labor cost has slowed a lot. And it doesn't look anymore for the U.S. as if reaching the 2% inflation target is completely out of reach, which was still the case a few months ago. In most other economies, except Japan, that's simply not the case. So I think that the fight against inflation has definitely not yet been won. And, what we talked about earlier, about the wage pressures in the U.S. auto sector, that's the kind of cycle that makes inflation last, is that you get high inflation, workers lose purchasing power, they demand higher wages, and companies raise prices. That's the age-old wage price spiral, which should really be called a price-wage spiral, because usually prices move first.
Fair enough. All right, Klaus, thank you so much for doing it. Unfortunately, we're out of time. Always a pleasure to have you. That's Klaus Potter of Societe Generale. Now, coming up, how much would you pay for a chance to get matched on an exclusive dating platform? Tinder figures it is $500 a month. That's its subscription for its most active users. And more on that next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg Brief. I'm Manus Cranny in New York with Danny Berger in London. Now, a story that caught my eye over the weekend. The dating app Tinder has rolled out a premium subscription service. Tinder Select, at its most active users, will pay $500 a month. The service is offered to less than 1% of its users, according to the company, with the access to features such as exclusive search and matching. Now, Danny, you can roll with this any way you want. This is the cost of love. You've got to be a power user. Question is this, right? I think I'm more the $24.99 subscription. $500 a month to find the perfect match. What do you reckon?
It makes me want to be single. That's what I reckon. What is this? Is this like love inflation? I don't understand. This is crazy to me. Although I have to say, I don't think people are on Tinder paying $500 a month to find love necessarily. I won't go much further than that. But this seems crazy to me, man. It's absolutely crazy.
Well, you know what? $25 a month is enough to swipe. Go find me. The other thing is, of course, the owner of Tinder is Match. And in 2022, they bought the league. Now, get this. This is an invite-only dating app. I don't know whether I constitute this. Tell me whether I do. Ambitious, career-orientated singles. Do you think I hit those 3 benchmarks? Apparently, it's a VIP plan for $1,000 a week.
Manus, if you're not that, I don't know what is. If you're not that, then something is broken. I'll be honest, I
think we might be stretching it at the young. I think we might be stretching it at the, it doesn't say young.
Yeah, it's any age, Manus. Love will cost you $500. Doesn't matter how old you are.
No, it doesn't. We're going to talk FX next. From love to FX. Which currency is the choice for Esther Reichelt? She joins you shortly, strategist from Commerzbank, right here on Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Welcome back to Bloomberg Brief. I'm Menace Granny in New York.
And I'm Danny Berger in London. Here's what you need to know. Fresh signs of concern in China's property sector deliver a Monday morning blow to global risk appetite. Wall Street's picking up the pieces as a higher for longer mantra sinks in and stocks flash a recessionary warning. And signs of hope elsewhere. U.S. Transportation Secretary says UAW and the big three car makers can still strike a win-win deal. Meanwhile, the end of the Hollywood strikes may be near. Now, let's take a look on your markets, because Manus is going to get into some of the doom and gloom on this equity market. A lot of it is emanating from China. Concerns about Evergrande. We're just hearing from Klaus Spotter. Yes, there are some concerns that it could come over to other parts of the world, but big-scale contagion, maybe we're not there yet. Even so, oil still climbing higher, up 0.5%, just below $94 a barrel. JP Morgan says we're going for an oil super cycle. Euro, that's also seeing its 10th straight week of declines. That is its most on record. Hedge funds there adjusting their bearish bet to the most in just about a year. Meanwhile, it's duration that has been under pressure, Manus. 30-year yield, that is off about 5 basis points. Same with the 10-year yield. We're looking at some curve steepening going on. It's everything from the higher for longer, Manus, to also the concerns of Treasury supply, shutdown, strikes. All those things are simmering in the background right now.
Yeah, and Bank of America make the point that you're probably going to see higher yields, 4.75%, Danny, in the near term, because it's the longer end of the curve where you're going to see the workout rather than the short end of the curve. You're right. When it comes to cross-asset risk, that is driving are being driven, I should say, really by what's happening on the equity side. We're going into the 4th week of a dip in these equities. We've had a downside shift in equities for 3 weeks in a row. S&Ps were down by nearly 3% last week. The NASDAQ was down 3.3%. So we've got this risk-off sentiment from Evergrande in China. It's a name that you know well. Yes, SocGen say it's contained within China, but you're looking at $1/3 trillion worth of debt on liquidation risk. And that will impact the consumer in China, perhaps not seeping globally across borders. But what you've got is the biggest outflow of this year from global stocks. $17 billion walked out the door. There is an underbelly of concern that that word "or" is back in our lexicon again. Recession risk. Industrials are down 8% from their peak in August. The Russell 2000 down 11% since the peak in earlier in the summer. European stocks down. That's where the real pressure is, and it's the miners at the bottom of your screen, which are down by 2%. That is the real source of angst. As iron ore comes lower, commodities under pressure. We're trying to understand the parameters of the impact of a liquidation of Evergrande. How pervasive would that be? How much contagion would that deliver? And whether that's going to cause the PBOC to come out with something much more substantial in terms of stimulus. Right now, stocks are on the back foot as we kick in at 5:32 New York time. But Danny, the debate really is about what we get on inflation data this week. We've got shutdown risk, we've got strikers, but we have the PCE deflator, and that, to a certain extent, will imbue the argument about whether you get another hike in the back quarter of this year.
Yeah, there's a lot of hope. We'll get a figure that comes under 4%. We'll get European data. There's hope there that it will start to come down. But Manus, I mean, you mentioned it. There's a lot beyond that. There's a lot that could upset things here into a week after the worst week for risk since March. We're starting on the back foot yet again.
Okay, well then that brings you to what is your hedge? Where do you want to be? How do you want to be positioned? Let's kick off the conversation with our next guest from Commerzbank. This is what she had to say. Anyone betting on a continued dollar strength or even appreciation should realize that this is a bet on the performance of the U.S. economy, which results in increased susceptibility of the dollar against weaker economic data. Esther Reichelt is the lady who wrote the quote. She's from Commerzbank FX. Esther, I was looking at the chart. I was looking at the quote. The dollar's rallied by 5%, give or take an eighth, since the middle of the summer. That rally is either going to be driven higher. We're in this risk-off mode, but you're concerned about growth. And with that in mind, that is what caps the dollar rally. Should we start there?
Yeah, clearly, I think this is the big risk, but because there is simply a lot of U.S. optimism priced into the U.S. dollar. This was supported, of course, by the Fed's view, which basically said that even if we are seeing a cooling of the economic dynamics, this will not sip through to the labor market. We'll only see a very slight increase in the unemployment rate. So if this does not play out as the Fed has painted at its last meeting last week, I think there is still the potential for a rather sharp correction of the recent dollar strength.
What could possibly rally against it, Esther? What would be the currency du jour in that scenario? Because I'm guessing if the U.S. economy is turning, surely euro is not where you want to be.
Well, yeah, clearly, because, I mean, of course, we are seeing clear signs for the recession risks in the Eurozone deepening. However, this is already priced in. So, in my opinion, the risks with respect to the economic risks, the risks to euro dollar are rather asymmetric. You know, like we would need to see a very serious surprise for the Eurozone, but only a very slight surprise with respect to lower growth, to a lower growth outlook for the US to justify higher euro dollar levels.
We're at 106 on euro dollar. The calls for parity, Esther, have been picking up. We've seen it recently from Capital Economics. What do you think? Parity? We're going to see it sometime soon this year?
I'm rather doubtful. As I said, I'm still thinking that right now the upside is more attractive because in the end, you should not you should keep inside the huge inflation risks. You know, we've heard it before in your show. The fight against inflation is not yet won, and this is, you know, like inflation is showing very much a global pattern, you know, like, so either inflation goes down everywhere or inflation might stay up everywhere. I don't think that we are seeing a very significant divergence in dynamics, inflation dynamics in the Eurozone and the United States. So I doubt that such a significant move in euro dollar would be justified.
One of the big debates, Esther, is whether you see a vicious second round pump higher like you saw in the 1970s. I do read the research. I went back and had a look. You talked about 1976. You talked about 1979. And you talk about the reemergence of a second round pump in inflation. I look at oil. I've got a number of houses telling me there's a super cycle coming, a renewed super cycle in the oil market. What is it that you see that could deliver that second round, really a second round pump higher in inflation globally?
Well, I think it's largely really the underlying risks stemming from the labor market, because to be honest, we simply are not we don't know very much about what is driving recent inflation dynamics. I mean, like central banks were surprised by the pickup in inflation in 2021. They were surprised on how robust inflation developed in 2022 and even in 2023. So what is giving us the confidence that everything will decline in exactly the way the central banks are expecting in 2024? I'm just thinking that the market is a little bit too optimistic with respect to these risks.
What does that do especially to my EM trades, the EM disinflation trade, expensive oil, Esther? Does that completely throw it out the window?
Yeah, exactly. I mean, in particular, if you look, for example, at Latin American central banks, they were very sensitive to inflation risks. I mean, yes, they have now started their rate cutting cycle. However, they really still show that this is just, adjusting to these extraordinary real interest rates levels they have by now reached. So I think as soon as we are seeing any signs of this inflation super cycle, of inflation levels picking up again and the risk, I think this is emerging market central banks might actually be the one who would be the first to react, in particular as the chances for a soft landing in these countries is quite promising. So I think this might actually where we have to look at for also to determine the risks for the G10 central banks.
Well, maybe that's the bigger divergence play. We're trying to understand China risk this morning. We're looking at it through the prism of the equity market, of miners, and to what extent it's going to impact the world. We've had SocGen say it's fairly contained. The Chinese have the power to contain the angst within the property market. But through the FX prism, the yuan has been literally, unleashed. It's gone lower and lower and lower. From a broader FX, Asia FX perspective, the weakness in the yuan, is it done, or what are the reverberations of this weakening yuan and a China in stress?
Well, the debt risk or the debt problem might be contained to China, but it's clearly showing us that China will not become, like a supporter of global growth anytime soon, because the problem will dampen the growth outlook for China for quite some time to come. And this also implies that the yuan will remain under depreciation pressure for quite some time to come. We have seen the PBOC stepping up their verbal intervention if dollar yuan moves too much higher. We have seen that they take several measures to dampen the up move in dollar renminbi. However, this will only, dampen the up move. The pressure is clearly to the upside, and we think it will remain there. So we would need to see, a substantial reduction or a substantial pickup in Chinese economic dynamics for this, for the pressure in dollar renminbi to turn around.
And then what does that feed into Japan, into the yen, Esther? Because you have a Bank of Japan governor who has continually reinforced that they are not there yet with a 2% inflation. If China continues to be a problem child, does he seem more and more right with every single day that passes?
Well, it seems like it, in particular, as long as global inflation levels move lower, there is a high chance that inflation rates will, continue to move longer. As I said, either it will work out for the whole world or it won't work out for the whole world. And for the Bank of Japan, the risks are clearly the highest, So if they wait for inflation to turn lower, as they expect, they might be confirmed with their still ultra-expansionary monetary policy stance. Of course, downside risks to the Chinese economy might help there actually, because it also dampens the outlook for the Japanese economy. But still, it's not the only thing they can bet on, of course.
So every day, Danny dreams of a more expensive lunch at the Ivy, the original one. She sends me messages with the menu, and she says, now you're in the big dollar league.
It's true.
You can afford this sterling lunch. Look, the ghost of Liz Truss hangs hard. It's a year ago we had the crash. Trussonomics trashed the pound, but the market is rebuilding its short positions. You say it was a tight decision, 5-4 in terms of the pause. When you look at the landscape of the UK, would you be loading up? I mean, the hedgies are loading up to short the pound. Is there renewed pressure to come? Are you a seller of the pound at these levels? We have Nomura talking a really bearish trade on that. Cable this morning, 122.20. So we're near the short point for Nomura. Is it getting tight for you in the pound?
Actually, not. I still think that the pound still looks attractive. It still looks attractive to sell the pound. I think the recent Bank of England's decision has clearly confirmed our view that the Bank of England is very reluctant to do what's necessary to fight inflation. Inflation risks in the UK still look quite high, in particular because they have a strong or quite a high wage inflation compared, for example, to the Eurozone. And even compared to the ECB, the BOE seems more reluctant, as they have shown with, like the recent rate pause. So we have been skeptic for the pound for quite some time now. It was, like too strong in our opinion. So we are seeing the correction we have expected, but we still think the correction to go on further.
All right, good news for Manus, who still owes me lunch at the Ivy. Esther, thank you so much for joining us. Esther Reichelt there of Commerce Bank. Now, coming up, we're going to bring you our exclusive interview with UBS CEO Sergio Armati. That's next. This is Bloomberg.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
It's Bloomberg Brief, Monday morning with Manus Cranny in New York and Danny Berger in London. UBS CEO Sergio Armati says it's making good progress on the Credit Suisse integration. He sat down with John Liu, Bloomberg's managing editor for Greater China, for a wide-ranging interview in his first trip to Beijing since taking over the helm again at UBS.
Things are progressing very well. We made a shift, very swift progress in integrating Credit Suisse. We closed the transaction in record times, also thanks to the big cooperation of regulators across the globe. And that's one of the reasons why I'm also here today in Beijing, because this is my first trip to Asia since taking on again my role at UBS, and I think it's very important for me to reach out to all the Chinese stakeholders and reiterate our commitment to China, while also updating them on the integration.
In your second quarter results, it mentioned specifically that client confidence, sentiment, and activity here in Asia was muted. Are you still finding that's the case into the third quarter?
Well, I think that we saw in general a little pickup in across the globe, also in Asia, in terms of client activity. The most important topic for us was to see the returns of assets that left Credit Suisse in Q4, Q1 this year. We started to see assets coming back at Credit Suisse towards the end of the second quarter. We see also very good momentum in Q3. So that's the most important issue. But also in general, it's fair to say that investors are more constructive than they have been recently.
So on the momentum you talked about in Q3, there was a net new money inflow of about $16 billion in 2Q. You said at the time you expected that to continue. What is it looking like in 3Q? What does good momentum mean?
Well, I mean, we are pursuing similar patterns, so we are not going to be specific on numbers. The quarter is still ongoing, but the most important issue is that we see substantially our forecast being confirmed, and we are getting to the close of the quarter. So I think that's very encouraging to see that so quickly our clients are responding to our actions to stabilize Credit Suisse and to offer them the best of the combined organizations.
It's taken your headcount, your staffing, to about 120,000 globally. And you've talked about, pretty forthcoming about the need to reduce that number. How much of a reduction do you think is needed at the end of the day?
I never really spoke about the need of reducing headcount because it's not it's not our philosophy. What we need to do is to restructure the bank. Credit Suisse needed to be restructured, profoundly restructured, because out of this situation, and then we need to extract the synergies that are necessary to make both businesses viable and stronger. So we are taking actions as we speak to resize the business. We are also taking advantage of the fact that we had natural attrition that is helping across the globe. We have demographic trends helping in that sense. People exiting the bank through retirements or early retirements. We are working also in facilitating movements of people within the bank, also between the two banks as we speak. So I think that I'm comfortable that we can mitigate the painful part of the job, which is the social cost. But it's very necessary in order to create a business that is sustainable.
UBS CEO Sergio Ermotti there, speaking exclusively to Bloomberg's John Liu in Beijing, warning about some of the fragility in China. Now, also in China, we have EU Trade Chief Vladis Dombrovskis. He'll be meeting with counterparts and business leaders. Let's bring in Bloomberg's European correspondent Maria Tadeo on this. Maria, what will the message from the trade chief to China be?
Look, it's going to be a striking message, and already we got a glimpse of it today in a speech that Dombrovskis made in China. As you say, he is on an official visit for 4 days. And again, a striking quote that really caught my eye, where he says, at this point, where you look at the relationship between China and the European Union, it is at a crossroad, and it is up to China to figure out whether they want to recalibrate and rebalance, so it is a win-win for both, or inevitably they will have to head in different ways. Let's take a look.
We stand at a crossroads. We can choose a path towards mutually beneficial relations, one which is based on open, fair trade and investment, and working hand in hand on the great challenges of our time. Or we can choose a path that slowly moves us apart, where the shared benefits we enjoyed in recent decades weaken and fade, and as a result, where our people and economies face reduced benefits.
So it's a win-win or lose investment. Those are the words of the trade boss for the European Union, Valdis Dombrovskis. And a lot of this, you can see the frustration is underpinned by that trade deficit, which keeps getting bigger. At this point, you're close now to 400 billion euros in a trade deficit that benefits China. The European says one European Union says they want to see that recalibration and make trade more balanced between the two countries, repeating no to decouple, yes to de-risking, and not an abuse of the single market. If China wants to enter this market, they have to open it up too for European competition.
Okay, Maria, yeah, and there is pushback here from the States as well in regards to the reach of China into the Middle East and across Africa. Maria Tadeo in our headquarters in Brussels. Coming up on the show, we're going to take a look at some of the market-moving events for you throughout the week. We're going to set the agenda on Bloomberg Brief.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now let's get you set up for your week and what is ahead. Central bankers will be coming back on stage. We have Chair Powell speaking on Thursday. President Lagarde will be speaking on Friday. Will we get any adjustments from the message that they had last week? Now, we're also going to get a host of data on Thursday, CPI out of Germany and Spain, plus, of course, U.S. GDP, core PCE, and jobless claims. So we get that under 4% print. And more data coming on Friday, the latest inflation out of the Eurozone, France, Italy, UK, and China PMI. Manus, for the time being, it is Europe under pressure from the China property woes.
It is indeed, and that is displaying itself perhaps most in the equity market, but the FX market will have a carry through. Danny, what you got here is, of course, dollar yuan, dollar up, yuan lower and lower to go, according to Esther Reichelt over at Commerzbank. Keep an eye as well on the Aussie dollar. Iron ore gets trashed, and as commodities come lower, high beta drops down 1/4%. Bloomberg surveillance is up next.
middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
To digest higher rates for longer will take time.
I don't think rates need to go any further than where they are today.
It's not so much the level of the rates that's the problem, it's the adjustment.
What's going on in markets is quite different to what's going on in the real economy.
The economic soft landing narrative is definitely being challenged.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene back in New York. Well, some of us are back in New York. Farrow on assignment. Lisa Abramowitz and myself to bring you a most interesting Monday on radio, on television. And Lisa, we can just get to the national rate adjustment that's going on, a veritable soup of higher yields. I'm going to go moments ago, the U.S. 10-year real yield out to new levels. I have 2.11, rounded up 2.12%. That's a higher yield.
The highest real yield, inflation-adjusted yield, going back to 2009 at a time where it's something that has something else to do than just inflation. It has something to do other than growth. There is something else going on, and Deutsche Bank put out a note saying this is partly quantitative tightening and this is partly something else, not tied to traditional reasons for why yields are going high.
Can't emphasize enough how much I agree with that. Olivia Blanchard talks about other factors. We're going to go over the other factors here as we stagger into October. One of the other factors we have, and I didn't see this in London, I get back to New York where there are no for sale signs up. Bank rate 30%, 30-year mortgage rather, bank rate 30, 7.75% 2 days ago. You wonder where that will print later this morning.
And we've been talking about who's paying it, right? I mean, that's the sort of question is this actually going into effect? Michael McDonough over in our Bloomberg Intelligence, our Bloomberg Economics came out and said that basically the average monthly payment has gone to about $2,300 from less than $1,000 in March 2020. That there is this feeling of just things getting more expensive in the basic day-to-day necessities.
You know, there's a number of swirls going on this morning, folks. And one of them is China, a mystery of what China is going to do. One of them is a strike. One of them is a shutdown. Good news from Hollywood. I mean, at least we got, thank God there's something out there. There's a difference between the screenwriters and the actors. Right. They wait on tables in different parts of the restaurant.
Exactly. I think the screenwriters wait on the ones in the back and the actors are in front because they're usually the front-facing ones. Okay, there is that good news. But I will say, is there the word quadfecta? I was thinking about this because everyone talks about the trifecta, but there's kind of a quadfecta brewing behind the scenes. There's the auto strikes, the government shutdown, student loan repayments, and higher gas prices. You put those together, any one of those couldn't necessarily derail the U.S. economy, but increasingly, in a lot of the reports that I read overnight, there was a question around, if put together, this is a different kind of, if you will, toxic brew.
Tension's there.
This to me, each one of them, it doesn't matter. You put them together, suddenly something feels different.
We're in a new studio here. What do you think? It's like, it brings back memory. I teared up, me and Scarlett Fu and Sarah Eisen. I got all emotional when I walked in the big room.
It's
they're
very nice
going to put a
room.
brass plaque outside, the Alex Steele room. That's what they're going to
Well, I know. I think that John isn't going to come back until we resolve the government shutdown issue.
Yeah, well,
I think he's particularly frustrated by the issue.
Now, to say the least. We should say we are building a new edifice for your morning attention. They're working on it. And so for 4 or 5 weeks, we're going to be here as well. The data check's the same, whether we're here or in our new studio, which you'll see. The VIX 17.83 says it all. Futures are in. The Gloom Cruise picked up on a number of those things Lisa was talking about, including China real estate. We'll touch on that. But -3 on the SPX futures. I've got nothing else really working here. We'll talk about the drawdown later. We got to do Bitcoin because John's not here. 26,000. Greifeld's up early watching, so
Good.
we have to do
I'm glad you
Bitcoin.
did that. Thank you very much.
Yields elevated, and this is the key point. We are 4.49%, almost a 4.5% on the 10-year yield. 2-10 spread gives us some disinversion. That's a really important philosophy. Jim Bianco land there. That real yield, 2.12%, is right where we are. That is an absolute key determinant. For me, I'd look at dollar strength. We haven't really broken out to new dollar strength, but yen rounded up 149. I wonder how they deal with it. What do you see in, Lisa, the data? Before you do the brief, what's in the data that gets your attention?
Crude. Going back up.
Thank you.
And I think that that's interesting, the fact that on WTI, you're above $90 once again, and that there was actually data over the weekend showing that hedge funds are now the most bearish, most bullish, most bullish on crude, on WTI in particular, going back to February of 2020.
We got to come back to this on short selling. Do the brief now, because young Kyle is going to hang up if we don't get to him.
All right. Well, you know how you don't like Fed speak? There are 7 Fed speaks this week. 7 Fed speakers this week. Just this week alone. No, Minneapolis Fed President Neil Kashkari at 6 p.m. Today. Tomorrow we have Fed Governor Michelle Bowman. Thursday, the big bonanza of Fed speak. Fed Chair Jay Powell, Fed Governor Lisa Cook, Chicago Fed President Austin Goolsbee, and Richmond Fed President Tom Barkin. And on Friday, the Fed's John Williams. Whether they really lean into this idea that they are done, because it seems like that right now in the literature, Ellen Zentner among them, saying they are done. Earnings, and this to me is really a big deal, especially off of Mike Wilson's comments over the weekend. Retail earnings in particular. Tuesday, Costco. This is fourth quarter. Wednesday, H&M and Micron. That is the whole semis kind of question. And Thursday is Nike. Curious to see whether these are bespoke stories or whether we get a theme that starts to come together. And on the economic data front, you talk about home prices and the mortgage rates. Well, we get home price data as well as new home sales, just how much this market is broken. We get that tomorrow. Jobless claims Thursday. And personal income, spending, and core PCE on Friday. That is key. Brief. The consumer, how much do they really continue to surprise to the upside the way a lot of the economic data has?
This really lays out the week ahead, folks. It's not a sleepy week into October. No. And for the first time, you can look at this, folks, on the Bloomberg Professional Service on the DES screen, the description screen, a plethora of data there. They have JP Morgan, October 13th.
Yes, I saw that.
October 13th. They've also got December 14th, which is when the Bruins pull ahead of the Toronto Maple Leafs. Joining us now, Luke Kawa, asset allocation strategist, UBS Asset Management. What'd you write about this weekend, Luke? What is the distinction you see in literally the cacophony of news we have?
Oh, this weekend is a lot more reading than writing as per usual, but very interesting for us to watch as we go into year end. A couple of things that seem like pretty big highlights or things that markets will be resolving is one, a lot of the, as Lisa's noted, there's the, I'll call it the quintet, throw in higher rates in there too into the mix of things the U.S. economy will be dealing with. We're dealing with a bit of a turn in the second derivative of U.S. growth from Q3 into Q4. So the most consistent trend in markets since May, we would say, has been U.S. growth both accelerating and surprising to the upside. That's something that's going to change. On the other hand, two of the biggest drags for markets, arguably in the past couple months, have been that resilience of U.S. growth that's driven the part of the higher real yield story. Also certainly elements of term premia and supply in there, but that possibly changing as a second derivative of U.S. growth changing and getting a little stability. So that relationship to us is really at the fore in terms of what we look at as driving markets for the coming 3 months.
Hey, Quantis, be sure that Luke gets the memo that we don't do Newtonian calculus on Mondays. There's a great rule about that. Luke, you've got a really, really smart idea that earnings haven't deteriorated, and yet the zeitgeist this morning is, should I sell stocks? Dovetail a non-deterioration of earnings with the idea I really want to get out of equities.
Well, I guess we would take the other view to that. We're not necessarily adding risk, adding cyclicality into this pullback at this time. But our view is that real underlying story is what's going to win out at the end. That there is a limit to how much good news for the economy can be bad news for stocks in terms of the valuation pressure. That you really are going to have the real key driver of earnings growth. And by the way, since S&P 500 peaked for this year, S&P 500 earnings estimates 12-month forward still up another 3%. We think that's ultimately the story that's really going to win out when it comes to the equity market. But we're very cognizant that some of the signs we've seen in markets recently, I would say credit spreads perking up a little bit, some of the outperformance of defensive equities. Those are just things that have us on alert, on watch, I would say.
So Luke, just if you could frame where you are, because you have been bullish for quite a bit, whether you're becoming less bullish now, just because of the quintfecta or whatever you want to call it, the 5 different areas coming together. I could see Tom looking at me like, what did you just make up? Yes, I'm trying to make up words on this Monday. But, at what point do you start to become less bullish and start to look for signs that maybe things are turning and the economic data is going to start surprising on the downside in a more substantial way?
Well, I think one thing that we do expect to see, or that we'll really be judging a lot in the coming quarter, is that that odd juxtaposition of the second derivative of turning in the U.S., but still expectations seem to us too low. Now you can quibble whether the ECFC economic forecast for Q4 GDP in the U.S. of about 0.5% are really what the market is pricing in. Market's probably pricing in a bit of a better outcome than that. But it's that juxtaposition of us. Okay, these temporary factors are going to be slowing growth in the fourth quarter. But even so, we probably see growth coming in a bit ahead of that. How does the market deal with the issue of the turn versus continuing to be positive versus expectations? We're very aware. We're very cognizant of the idea that as you slow, as you turn, there are going to be points in this market where it's going to be tough to tell whether you're heading for a soft landing or whether that deceleration continues and you're heading into something a little more severe of an outcome. Our view so far is what's shaping up in the fourth quarter is not going to be that latter, more negative outcome, but something we're definitely going to continue to monitor in the weeks to come.
If yields stay where they are, can stocks keep doing well?
This is interesting because it's almost a mirror of the question that we asked when we started the year. Can the economy handle a 5% potentially federal funds rate for the entire year? The view then for us was yes. The view then for us with stocks is that stability is really what's needed, much more so than yields coming down a lot for stocks to work. It's just that the negative momentum in the bond market really does have to calm out. The positive momentum in oil prices really do have to cool a bit, and that cooling in the second derivative for rates and oil is going to be something that offsets that turn in the second derivative for U.S. growth and net out a little better for risk assets is our view.
Are you still bullish on China?
We've been neutral on China for a while now. Hopefully we discussed last time, but it's just in China, it's the continued dichotomy between the fact that valuations are very depressed. Right. It's not clear that there's a catalyst to see higher, faster growth in China. But when risk assets in China are at this depressed valuation, when they're this unloved by fund managers, that it's often a time where you get to see more meaningful moves to the upside. So a neutral view on China, but we're really counting on some of the piecemeal stimulus putting more of a floor under growth. Don't expect anything bigger from Chinese policymakers in the near term.
Look, your charm is a student of the street. What's the bet on the street right now? Is there a massive short bet out there?
I'd say the bet on the street is continuously, everybody knows what history says about buying the last Fed hike, et cetera, buying the end of cycle hike. I think the big bet is also right now the big worry. It's the idea that, Lisa talked about in the intro, just these other factors that we're seeming to be pushing up yields. That's making the term premium argument. The most difficult thing about the term premium is nobody really understands it. We're all going to have very, very different definitions of it. But usually some of the things that people associate with term premium, they're going to correlate with how growth and inflation are moving. What's different this time is that supply is moving much more much more pro-cyclically than it has in the past. So that's something where you have this element of term premia that we've typically come to have associated as being associated with growth, with inflation, that might be moving in a bit different direction this time. And that's what I think causes a bit of a scare to relying on your kind of traditional models for how and when to be adding a lot of duration.
Lukawa, UBS, thank you so much for getting us started strong here on a Monday. Merriam-Webster, thanks so much for watching in Springfield, Massachusetts. Merriam-Webster emails in and says, what in God's name was that? Bramo's quinfecta, it's like a trifecta or a quadfecta, but I think it perfectly captures where we are. I think you nailed it, Lisa. The quinfecta that we're in here is all the reasons not to participate.
Well, I originally thought it was a quadfecta, but Lukawa was grateful. I was grateful enough to him for making it a quinfecta. This is the issue, and we talk about toxic brew and we laugh. Yeah. But when you put certain things together, they take on a new meaning than if they were just taken in isolation. Right. And I think that's the reason why people are starting to feel like, maybe this time we're going to care a little bit more about a government shutdown in tandem with all the other factors. Our
focus after London and the greater picture is market dynamics. Luke Cowell with us with UBS. Coming up, Katie Kaminsky, Alpha Simplex Boston. She is absolutely brilliant on the trend, the new trend, or is it a range? Stay with us. Futures at -2. This is Bloomberg Surveillance.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I still believe if you shut down, you're in a weaker position. You need the time to fund the government while you pass all the appropriations.
So does that mean you're going to try to push forward with the Republican CR still?
I would like to. You need to.
He is the beleaguered Speaker of the House, a gentleman from California, Kevin McCarthy. Really interesting background from below the Imperial Valley, Bakersfield, California. Just a whole different story there of Republican politics. And I just really can't say the moment we have Lisa over the weekend. There are various sundry people in the Keene House. And of course, we were in London. You know, Vet Bill, I got home, was mental. So Vet Bill demanded we have an Arnold weekend. So I had to watch like 5 Arnold Schwarzenegger movies. And I put on for various people in the family the Arnold Schwarzenegger speech at the 2004 Republican Convention. It might as well have been from Venus or Mars compared to what McCarthy's putting up with today.
Does Vet Bill drink
California
martinis while he
No.
requests Arnold Schwarzenegger movie?
He gets the olives, though, and there's no question about that.
We'll
McCarthy
see.
is beleaguered as Schwarzenegger never was. We're going to do a market check, and we're going to get to this, and this is a shutdown in this week. Lisa knows when the shutdown occurs. I have no clue. Red and green on the screen here. A little churn of the tape within the Bramo quinfecta of tension. Yields say it all. Lisa, comment on a 4.49% 10-year yield. Wow.
Well, Luke picked up on this, right? This is being driven by something ambiguous. It's not that inflation expectations are going up. It's not that growth expectations are going up. Is this something else, whether it's people protesting the budget and all of that? Is it because of that? Or is it simply because the Federal Reserve is selling bonds? They are not the buyer of last resort in the same way. And it's the same with the ECB. And this is a game changer in a very unusual cycle. And that, I think, is something a lot of people are picking up on.
We're going to watch this very carefully as Global Wall Street greets the week 2.12% in the 10-year real yield curve disinversion. We'll get to that with our economists here in a moment. We need to jump now to one of a set of series of interviews we're going to do to brief you on a shutdown of the federal government of the United States of America. It is different than many other processes: debt, deficit, budget shortfall, and all the other fancy words only Anne-Marie Horton understands. Briefing us on Washington's from Strategas, it's a Baird company, Jeanette Lowe, Director of Policy at Research. Jeanette, you got a 75% odds on shutdown. What will you listen for today or tomorrow to change your odds to calibrate a government shutdown?
Well, good morning. So we won't have Congress really start to work on any of the potential bills until tomorrow. So that is where we're going to start to see the process really develop. Our anticipation is that the Senate is going to move first. They are going to try to put forward a short-term continuing budget resolution, so that will keep the government funded for potentially a month, 2 months, up to 3 months into early December. And then they're going to send it over to the House. The House then has to decide, do they have the votes to potentially pass that CR, even if it's with changes? Or does McCarthy have to then move with the Democrats to try to pass this? Or does he allow the government to shut down? So we're going to be listening to the rhetoric that we hear within the House. You have heard a lot of Republicans over the past week been frustrated by the handful of conservatives who have blocked any movement. And so as that chorus might change, we may be able to see this potential change that we won't hit a government shutdown if they're willing to work with Democrats.
Asking for a friend, Bramwell went into Morristown on the Gulf Stream. She took the Gulf Stream back from London. I had to go through EWR. If there's a shutdown, is the border check customs lines worse than they were when I came back 2 days ago?
So that is always the risk. And there's been already some thoughts about, you have to be careful that you might see more delays at the border and at the airports. They do have an essential component to a shutdown. So anything that is deemed essential should still be in operation. But as we've seen in shutdowns in the past, if you're showing up to work and you're not being given a paycheck, sometimes people don't actually show up. And so that's where we've seen some issues in the past with FAA and transportation screening and all the like.
This is a maddening issue, Jeanette. There are going to be 800,000 workers, including people who are military, people who are teachers, people, the rank and file, who do a lot of the work in the country, who are not going to be paid as there is this shutdown. And this comes at a time that's fragile, right? How much is this really going to end up being a political tit for tat, where Democrats count on Republicans as gaining sort of the brunt of the blame for this? And how much is this going to be something larger that leads to an economic slowdown that leaves both parties with egg on their face?
Yeah, so we've seen in the past, looking historically at the shutdowns that have occurred, and there's been quite a few over the past number of years, in general, they do not have a major economic impact. So you do have people who are furloughed, they are not receiving paychecks, but generally shutdowns last on average 8 days. The government reopens, that fill is then paid back. There's retro pay, and so everything kind of is filled in to some extent. So there hasn't really been a large economic impact. The last 6 shutdowns occurred in quarters with positive economic growth. The issue this time is that we're also now seeing, the auto strike that is occurring. We're seeing increasing pressures on consumers from student loan repayments, higher oil prices. You continue to have, the Fed has higher interest rates, and that is leading to higher debt issuance in the U.S. So these things are also putting a strain on the U.S. economy. And so the longer the shutdown lasts, that's where the issues really become into play. If we look back at the 2013 shutdown, that one lasted 16 days. So that was, 2 weeks is a long time, but it's not as long that it has as big of an impact as you might think. And so if we have something about the same time period, then that wouldn't be that egregious to the economy overall or to the stock market. But what we do have to think about is, how does the government reopen? And usually there is political pressure that starts to kick in that then forces the hand of policymakers to actually get back to this. This one actually could end up being shorter, or it could end up being longer. And the longer it lasts, I think the more risk there is to the economy, to the markets. And the other thing we're kind of watching out for is there something like Moody's could start to put the U.S. on credit watch if this lasts particularly long, because the credit agencies have been more focused on process rather than even the U.S. finances and those decisions.
Amid all of this, President Biden is heading to Detroit on Tuesday to join the picket line. It is the first time that a sitting president has joined strikers going back, I believe, more than 100 years. What is the significance that the focus is all going to be on Detroit rather than Washington, D.C. amid this shutdown?
Yeah, so one of the things that obviously for Biden too, if there is a shutdown, there's obviously a political price to be paid, but Biden actually could have an opportunity here to improve his standing and actually show that he's trying to work to have the government reopen. But I think the fact that there is a lot of pressure on the auto workers is also trying to highlight, at least from Biden's perspective, a little bit about the impact that this could have on the on the economy. And so that's going to be really important ahead of these decisions, because unfortunately, we're probably not going to know whether or not we're going to shut down or not until about Friday or Saturday, right as the deadline hits.
Jenna, help me here. And I just listened to you very carefully on the path of a shutdown. If it's 8 or 9 days and everybody gets retro pay, etc., why are we doing this?
So this is usually about making a point. So if we look back at the 2013 shutdown, that was really a shutdown that occurred because the Republicans were looking to block funding for the Affordable Care Act that was going into implementation at that time. This is now an argument about saying we want lower spending and we want something done about what's happening at the southern border. And so usually the people in Congress feel that doing a shutdown will allow them to get their message across. It has not been particularly successful. They do not necessarily win concessions. And in fact, this time, if we look at what might ultimately happen, we can see where the bipartisanship is in Congress, that we're going to have a spending deal. It's going to be higher spending than the conservatives want, and they're the ones who are pushing for this shutdown. And they have to see whether or not they're going to have leverage to actually get something done on the border, which is ultimately what they want. So shutdowns have not been particularly useful political instruments. They do not get much of a point across. They kind of allow people to get their frustrations out, but then we have to go back to governing. Now that can be a positive outcome, that we've kind of fleshed out some of the frustrations within both members on both parties in Congress. But then you have to reopen the government and you have to start governing again. And that actually can be a positive outcome that comes out of this.
Jeanette Lowe, thank you so much. Greatly appreciate it. We're going to continue to monitor this. I need to tell you about balance of power, a very focused attention on what we see going on in Washington. Joe Matthew, Amory Horton, Kaylee Lyons helping out as well. Balance of power, look for that in the early evening, each and every day. Holger Schmieding, Berenberg, next.
best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
On television, thank you for joining us. Thrilled at the anecdotal evidence that was discerned in London about a global audience. We're thrilled you're with us around the world, and Awakening America is well. We do a data check here. Futures flat, I'm bored. No, I'm not. In the yield space, volumes are being spoken. 10-year real yield, a new level, 2.12%. What'd you say, back to 2009?
Yeah, March 2009. I just want to point out, okay, every Thursday at 4:30 p.m. Eastern, I am the person who looks at the Fed's balance sheet.
It's just...
And I've been watching it, and it's fascinating. It's down now to about $8 trillion. The peak was about $9 trillion.
So that means
it's about
we're more
$1 trillion
restrictive.
of bonds that they have allowed roll off. How much is that the underestimated story behind the real yields continuing to climb when it is a global quantitative tightening?
It's an overlay, and I look at the Bloomberg Financial Conditions Index, 10 ratios. You don't have to memorize it. There's not going to be a quiz. It's become a little more restrictive in the last 3 or 4 days as well, 0.19%. Really not restrictive, but not the accommodation that was confounding Chairman Powell earlier. One other quote, as Lisa mentioned earlier, Brent crude rounded up $94 a barrel. We are over the Atlantic Ocean, flying in, doing circles over White River Junction, Vermont for an hour.
Not that
2 hours. I was like, are they going to run out of gas? All they want to run out of gas. I'm glad we're looking at Mount Katahdin under surveillance this morning. Lisa Bramlett.
Well, what we're talking about is sort of the Midlands, right, and what's going to happen there. This morning, we're watching President Biden, who's going to be joining the picket line in support of striking UAW workers this week. He will be speaking from Michigan on Tuesday. This comes ahead of Wednesday.
So on Wednesday, does he go to the board meeting of Ford?
Well, that's the question, right? The union is expanding its strike against automakers GM and Stellantis, not Ford. They're being spared against the strike with the warehouse and distribution centers as the two sides continue to work on a new deal. I wonder how this is going to play. Is he picking sides at a time where auto manufacturers are getting subsidies from his policies with some of the electric vehicle makers? And then, oh yeah, by the way, former President Donald Trump is going to be there on Wednesday instead of going to the debate that's going to be happening.
To me, and John was very good about John. Remember John?
I do.
Farrow?
Yeah.
John was very good about this. He's on assignment in England, by the way, folks. Somebody said it was at Arsenal Tottenham, and I said, yeah, I think so.
He actually has a very cool project.
But
we'll talk
he's
about
got
that
a
later.
project going on post-Arsenal Tottenham and his huge success with Daniel Levy, really making global newsways there. And Lisa, what was so cool there, to John's point, is any of this environmental stuff feasible? Is it economically feasible? And that's a whole side project into Q4.
Is it economically feasible on the time frame that they're talking about? And this is with the whole Rishi Sunak London kind of flavor where he's pushing back and actually delaying it. Yeah. The other thing that we're focusing on is, as you pointed out, this resolution, baby, the Hollywood writers' strike. maybe coming to an end. You could see the move in Disney and Netflix this morning. The WGA and major movie and television producers announced a tentative deal late Sunday night. The new agreement is expected to lift pay and create new rules around artificial intelligence. Meanwhile, the Screen Actors strike still ongoing.
Right.
This, to me, the changes in technology underpinning some of the angst fueling these strikes is something we cannot talk enough about, I think, Tom.
So if you go down to the University of Texas and get a graduate degree in screenwriting, it's lifetime employment. That's what this agreement's about, right?
Well, I don't know the contours of the specific. Well, she can read the details and then come on and we can interview her. But I am curious about that.
What else you got?
The EU's chief trade negotiator warning China that the bloc will ramp up pressure on fair trade. I find this fascinating. Valdis Dombrovskis, executive vice president for the European Trade Commission, made the comments. He's in China right now. He said the EU welcomes competition. It makes our companies stronger and more innovative. However, competition must be fair, and we will be more assertive in tackling unfairness. Early this month, of course, the EU did talk about some sort of new probe into Chinese subsidies for electric vehicles. But this trip in China by Valdis Dombrovskis, very interesting at a moment that is pivotal for European-China relationships.
In particular for Germany, it was interesting in London to see the distance between Berlin, Frankfurt, Bonn, and London as well. With a voice on this, picking up the debris of our London trip, is Holger Schmieding, his chief economist at Berenberg, and has been incredibly perceptive about this linkage of monetary and fiscal economics in Europe and China.
Which is really a key question at a moment of flux. And Holger Schmieding, I would love to get your opinion starting on what we were just talking about, which is this trip of Valdis Dombrovskis over in China. What is the likely outcome to some of the rhetoric that is increasingly hardline out of European leaders?
Well, the likely outcome is clear. Germany, the European Union, is reducing its dependence on China. De-risking is the word, not decoupling. But the message from Dombrovskis is clear. We are serious about this. And in a way, we are self-confident in Europe. Yes, we do have some economic problems, but China probably has economic problems that are worse. We are the bigger market than China. We, the European Union, don't have to just accept what China does with subsidies, with its distortions. We can push back.
Well, is there a sort of a tacit acceptance of slower growth or even recession during this transition process away from really depending on trade with China?
There is a tacit acceptance, yes, that of course the de-risking with China will mean some short-term losses. It also is an acceptance that yes, if we want to be less dependent on China in the long run, an economy, China, that is actually struggling and will likely continue to struggle for quite a while, it means we get less boost out of foreign trade with China. But having said that, the lesson we've learned from Putin is clear. If you're too dependent on somebody whom you don't fully trust, you may eventually pay a heavy price for that. So it's probably worth de-risking now with modest near-term pain in order to secure a longer-term, fairer, more equal relationship with China.
One of the great criminal acts in New York City is the Oak Room at the Plaza Hotel has been shut for, I think, 20 years. Absolutely ridiculous, beautiful and historic room is well. Holger Schmieding, right now with dollar, day after day, up, 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 day after day, euro, down, 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 over 9-10 weeks, whatever it is. Are we getting a distance to a Plaza Accord? How many kilometers are we from the discussion of a new Plaza Accord?
I think we are quite far away from any discussion of that. So far, the move seems to be gradual. It's not disruptive. It seems to reflect that the U.S. economy is holding up better than expected, whereas the Eurozone is kind of in stagnation. So as long as the currency moves gradually and does not seem to be fully out of kilter with fundamentals, I don't think we need a massive intervention. Come next year, with the European economy picking up again, the Fed cutting rates sometime next year, and the ECB possibly not cutting rates, the euro will likely recover on its own.
This is really, really important, because a key thing there you said was we are not disruptive right now. Market participants feel we're disruptive. We're making jokes about a quinfecta, 5 different things we're bouncing off of right now. What is the policy, the best policy prescription for Lagarde and government leaders in Brussels?
I think it's basically now stay the course. For monetary policy, okay, I think we've tightened a bit more than we should have. But now the fairly clear message is we are probably at the peak, which has actually been, when it came out, been sort of reassuring for markets. And for fiscal policy, I would say the same, stay the course, which largely means we have a big fiscal program in Europe, this Next Gen EU program, which is now above 800 billion. The task is more to make sure the money is being spent, that is the rollout of the program, rather than thinking about any new money.
Is Jerome Powell central banker to the world? Is Jerome Powell, whether we want to admit it or not, central banker to Europe?
Not quite. Europe is not that dependent on the US to really say so. For Europe, it really is Madame Lagarde, the central banker, that we are glad to watch.
Do you think that people are too bearish in Europe? Is that basically what I'm hearing from you?
Not for the next few months. We are having a sharp inventory correction in manufacturing. We talked about China. The US economy near term will probably be slowing down. So near term, trade export dependent Europe is having trouble. But come next year, global manufacturing will pick up. The inventory correction will be over. Next year, I think Europe could actually surprise here and there a bit on the upside.
Will some of this slowdown and surprising negativity in Europe correct inflation?
Our inflation doesn't have that much to do with domestic demand, a bit. Inflation is coming down largely because this big Putin shock on energy and food prices is largely fading. We have a bit of wage inflation to pass through for the next half year, but all in all, inflation in Europe is heading to probably around 2.5% by the second half of next year.
Okay, but this to me is really the dilemma, right? If it's not going to really lead to low inflation, if we're facing a stagflationary type of environment in Europe, how much is that the template that we're basically being forced to live with higher inflation, even with taking the pain of de-risking, even with taking the pain of recession, even with all of the other toxic brew of the quinfecta that we're talking about this morning?
Well, stagflation is a description as to where we are now probably in Europe. We may see later this week already a fall in this inflation rate year over year into the 4% handle from a 5% handle, basically on base effects. And again, the big rise in energy, especially gas and electricity prices late last year, drops out of the comparison. Goods prices are stabilizing. I think that even without needing to constrain demand further, inflation will fall to around 2.5% by the second half of next year on its own.
I look, Holger, at our trip to London, and I look back on how Europeans, the United Kingdom, how they perceive an America in disarray. How's it different this time?
Well, it is a weird perception. On the one hand, we marvel that the US economy is holding up better than expected despite the massive Fed rate hikes. But we find reasons for that. Yes, consumers and companies had good money to start with, yeah? But when we look at anything that comes close to US politics, we basically shake our heads. Right. How is this going to end? Was there another talk of a government shutdown?
Yeah,
we've had that so often, it's kind of ouch. By those standards, we think European politics, especially the ones in Brussels, actually, are not working badly.
It's running like a Swiss watch. Good luck leaving JFK. Holger Schmieding, thank you so much, with Berenberg. And on that tune, Greg Valliere publishes this morning. He's been such a support of Bloomberg surveillance. And Lisa, it's really simple. He frames out the McCarthy options, and Valliere says this could be a crisis, quote, well into winter. I find that sobering.
It's one of ideology more than practicality, and that is something that people have talked about, because even if some of the desires of the holdouts goes into effect, the deficit is only going to decline slightly because it's really just a small package of cuts, not affecting Social Security payments and some of the other major elephants in the room that a lot of lawmakers say need eventually to be dealt with.
I mean, that's as Churchill said in St. Louis a few years ago, somehow we get through it all and get it done. Where will we be October 2nd? Where will we be October 3rd? It's going to be interesting to see, to say the least. You see the poll this weekend?
Which one?
Washington Post to ABC.
Which
They've got Trump 80% ahead of Biden or whatever the number is. And it was such an odd poll. It speaks to modern polling. I think we've been very good about being suspect about that. That even ABC Washington Post came out and said, we're really not sure about our polling.
Honestly, I think it's so early. I feel like I'm channeling Tom Keene. So early. How can we know anything from these polls? I'm really curious to see who's going to actually be in the running. I mean, to me, the bigger question is going to be, you know, do you end up with the Virginia governor as the front leader of the Republican Party? Do you end up with a different candidate for the Democrats that comes to the fore? I think that's increasingly the discussion of, is this really the field that's going to make it to the end?
Into the Republican debate, I believe it's Wednesday. We'll have coverage of that across all of Bloomberg as well. Futures, well, there was a tone here hours ago. They were up, and then they were down off of China news. We'll get to that. Futures -6 right now. Dow futures at -35. VIX getting out to an 18 level. That's important. 17.98. The VIX, you know, 14, 13. Life is good, and we ease back. We'll do the drawdown for you here in a bit, but 2.12% on the 10-year yield permeates the American financial experiment. That'll be interesting to watch. Brent crude, 93.44, up fractionally this morning. Gold, 19.43 the ounce. Lisa Bramwitz and Tom Keene, Jonathan Farrell on assignment. It was a draw. This is Bloomberg. Good morning.
For the first, you know, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, you know, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
We can and will go all out if our national leadership decides the companies aren't willing to move. Stellantis and GM in particular are going to need some serious pushing. All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike.
Sean Fain, inch by inch, mile by mile, factory line by factory line, leading a strike at the UAW. Sean Fain, president of the UAW. That on Friday, which seems distant, on Stellantis and General Motors as well. Lisa, this is for real.
38 new plants, none of them being Fords. What did Ford do right that GM and Stellantis are
What
failing
they did
to do?
right is they agreed to negotiate. They walked in the room in Dearborn and they said, we're different. And I would also point out they didn't go bankrupt, which I think is a heritage issue here on the seismic shift to the UAW of the time of Steve Ratner, the car czar, and the restructuring of American manufacturing. All of that's great. Quick market check here. We did one before. Why do one now? 2.12% on the 10-year yield. That's a huge deal on the real yield. That's life-changing for all of us. 93.53 on Brent crude. I got a little bit of red on the screen. The VIX nearing 18 level. There's some tension in your markets on Monday morning. Right now, joining us, following us across the Atlantic Ocean, Lisa had the Gulf Stream. Craig Trudell and I had to fly conventional. That was a nightmare. Joining us now, running all of our auto coverage, Mr. Trudell, of course, in Bloomberg, on his way to Detroit. I want to rip up all the discussion about the strike and understand that Eisenhower or Kennedy or LBJ didn't join the picket line. To me, this is a huge deal. Biden will picket. Am I wrong?
There's been a lot of question about that, and I think the fact that the UAW went from being in no hurry to invite him to inviting him is really fascinating, and the fact that when it surfaced that Trump had plans to go visit workers, the union very clearly gave him a sort of brushing off and a sort of you're not welcome here message. So the politicization of everything is coming to cars in ways we haven't seen before.
Is Gina Raimondo, the Secretary of Commerce, a governor of hugely labor-centric Rhode Island, is she going to drop by Dearborn and have a, Nescafe or a Sanka? What is the Secretary of Commerce? How does she respond to her president?
Well, it will be interesting sort of where the lines are drawn here. I do think, at the sort of factory level, we have our reporters in Detroit have been speaking with workers on the picket lines about their sort of level of comfort or lack thereof with Biden joining them in these actions. I think they are a little bit wary of Biden because of what happened with the rail strikes, the fact that he sort of inserted himself there. That being said, this is a president who, calls himself the most pro-union president in history, absolutely has made no bones about the fact that he wants to get behind the labor movement in the U.S., and absolutely is sort of putting money where his mouth is in terms of freeing up IRA funds the way that he was trying to structure that law before it was passed to actually benefit union-made EVs. He wasn't able to get that done, but nevertheless is very much going out of his way to boost labor in the U.S. in the auto sector.
Let's build on that. There was a really awkward moment on Face the Nation over the weekend with Alexandria Ocasio-Cortez, the representative from New York who bought a Tesla during the pandemic and had to talk about how it wasn't union-made and try to square this circle that the Democrats are kind of facing, which is they want to put forward electric vehicles, but it's not benefiting some of the constituents that they want to really say they represent. How much do you feel that angst and reconsideration in the policies that you hear out of the White House?
I think it's really interesting the fact that Ocasio-Cortez, by the way, I should mention, has said before that she was looking to trade in her Tesla. So I think this is a sort of long in the works sort of move away from Elon Musk on the part of some members of Congress in Washington. But absolutely, it's the case that the union was not making a ton of electric vehicles until very recently, and for the most part, the cars that they are making that are electric are on the higher end side. Cadillacs and big pickups and pretty expensive vehicles that you wouldn't necessarily see foresee an AOC in necessarily. I think we're going to see that change in the next few years in a pretty significant way. Maybe the lone exception in terms of the Detroit 3 making a sort of cheap electric vehicle has been the Chevrolet Bolt, and they haven't really made those in very significant numbers, in part because the demand has not necessarily been there. But we're seeing a huge movement on the part of General Motors and Ford in particular to try and move down the price scale and bring electric vehicles to more of a mass market and follow Tesla into that.
Let me put it this way. How much is President Biden considering doing what Rishi Sunak did last week? This idea of pulling back from some of the more ambitious goals to roll out electric vehicles in the United States?
I think it's more of a case of the U.S. I do think we have to sort of, call strikes here. The U.S. is far behind in making the electric vehicle transition that Europe has been making for several years now. There's a lot of concern in Europe lately about the fact that the IRA is really, going to make an effort to significantly change that. You want to talk about anti-subsidy investigations that the EU just launched against China. The amount of money flowing into this sector, not only on the consumer side, obviously there's a lot of attention on $7,500, but a lot into the manufacturing sector, and that's leading to huge investments. And so there's a real effort to play catch up here, and for the unions to sort of come along in that journey.
I want to make clear, folks, this is the Bloomberg Advantage. We've got the team, Keith Naughton and all in Detroit. They're not in speaking terms with Trudell, but that's a different story. We've got Craig in London looking at the global EV market. And what I learned in London, way ahead of us on all this chit-chat in Europe and China, is that we've got China, 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 and we go back to Don McLean, American Pie, and we got a Chevy going over the levee, but the levee's dry. Not good. Okay, so what does Chevy do over the levee to compete against China? That's the heart of the matter.
I do think that one of the interesting things that we're seeing is an attempt to kind of, go from a global industry to kind of battening down the hatches and bringing manufacturing to regions. Come on,
stop. Let's cut to the chase. Are we going to build American non-union EVs in South Carolina, or are we going to try to build a $40,000 fake cheap EV in Dearborn?
I think we're going to try and build a lot of Chevys in General Motors plants that have been making combustion engine cars. I think we're also going to see new plants go up in the South, interestingly, from some of these Detroit companies. So you see Ford making big investments in Tennessee and Kentucky. That is the big question and the big rub of these union negotiations.
Is that in the negotiations right now?
I think in terms of the electric pickup that they're going to make in the South, I would be shocked if that isn't a unionized plant.
Lisa.
But in terms of the battery manufacturing, that is the big rub, because these are joint ventures between Ford, General Motors, and Stellantis, and companies that are not necessarily unionized and have little desire to be unionized.
And down in the South, when they're doing union or non-union, they'll be drinking whiskey and rum.
Okay, can I just tell you, my favorite part of every day is when you ask a question like that, and then the guest has to answer completely seriously without laughing, and with you about to break into song.
This started?
Seriously, that's my favorite part of the day.
We could do this with Craig. Craig has been a huge value add for us. I'll take 30 seconds here. Lisa, jump in here when I'm talking too much. We're in radio. We're inventing Bloomberg surveillance with John Farrell. That itself was overtime at work. And I started, he's going on about Africa or something. And I started with the lyrics of Toto. And John's looking at me like, what have I got myself? Go.
Well, honestly, it's just my favorite. I just want to finish up with, how close are we to some sort of resolution? Are we hunkering down for this lasting a very long time?
I think we got a positive message from Sean Fain last week about some progress on the part of Ford and the union, but I don't think that we necessarily have the details from his comments to really have a strong sense of just how close the union and this company are. My bet is that that this will continue probably for several more weeks, and the folks in Dearborn are just hoping that we don't see any setbacks and sort of feeling of bad faith on the part of the union that not only prolongs this strike, but results in the union adding additional Ford plants to the strike.
For fossils like me, it's simple. This Biden walking the picket line is just stunning.
It hasn't been seen for more than
I wonder if I'm overplaying this or underplaying this. No question.
We don't know if he's going to be doing that, though, yet at this point.
Oh, we don't know
We don't know if he's going to be walking the picket line.
Oh, I thought we did know that.
He will be there addressing them, right? We don't know.
I was just going to say in Dearborn, I hear the drums echoing tonight.
Okay, honestly. I mean, you're like the Chevy to the levee, but the levee is dry. Craig, what do you think about the levee being dry?
Did you see Don McLean playing with Toto? It looked great. Futures to -2. The group says, everybody put a cork in it. Stay with us, I hope.
Change.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
With sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg. On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
To digest higher rates for longer will take time.
I don't think rates need to go any further than where they are today.
It's not so much the level of the rates that's the problem, it's the adjustment.
What's going on in market is quite different to what's going on in the real economy.
The economic soft landing narrative is definitely being challenged.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance on radio and television. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. John Farrow on assignment after a 2-2 draw at Arsenal Tottenham. I watched the highlights.
I did too, actually. I was trying to make sure I kept up.
Very good. Farrow recovering from that. We hope to see him maybe tomorrow because the Gulfstream's over here. So, I think maybe
Okay,
Wednesday.
hold on. Let's just make this real clear right here. Yeah. I do not take a Gulfstream or a private plane because people have actually stopped me and said, why are you not on a private plane? I have never taken a private plane before in my life, but carry on.
I was stopped in Heathrow about Lisa on the Gulfstream and said, well, the Bombardier we're looking at, but we just don't think we can pull that off. Futures in -1, Dow futures -14. You're waking up on a Monday to a changed world. Bramo nails it with a quinfecta. IDF 5 or things in a swirl. Let's go to something we haven't talked about yet with the real yield up to new highs, new generational highs, 2.11%. China, the developers, that story unravels to the point I think I can say there's no bid in the market because there's no market.
There is a feeling that something could happen where there could be a real default and suddenly there is a difficult scenario that the government can't control or is unwilling to control in a meaningful way. We talk about the quinfecta, and that includes real yields. It also includes the auto strikes. It also includes a government shutdown. It also includes this idea of higher gas prices at a time where oil prices are rising yet again today. And you put that together, and it's very hard to see how any of them, yes, maybe in isolation, not that significant. You put them together, it feels different.
It's like Craig Trudell and the EV vehicles. Well, who cares? Nobody can afford them but the rich people. I'm going to look at the housing market where nobody can afford to do housing except the rich people. And while you and I were sojourning in London, I thought, I wasn't in Mayfair. I was west of Mayfair a little bit looking at a closet. Bank rate 30, 7.75%, rounded up. How close are we getting to an 8% mortgage.
At a time where perhaps not a lot of people are paying for them, for that kind of mortgage rate, because you can see that the housing market's basically broken. On the other hand, it highlights how expensive things are getting. Mark Zandi of Moody's over the weekend put this out.
Yes,
and he said it costs $734 more each month. That is thousands of dollars a year each month to buy the same goods and services as it did 2 years ago for the average median household in the United States. You start looking at that, you understand some of the dissatisfaction. You understand why people are less concerned about the pace of the disinflation and are still looking at just outright inflation and making a lot more discretionary choices with their buying.
We've got a guest on this in the market dynamics. If you're part of Global Wall Street, Catherine Kaminsky will join us here in a moment. Shall we brief?
Let's brief, because this has to do with the entire week ahead and really framing out this discussion of real yields climbing to the highest levels or about the highest levels since 2009. 7 Fed speakers. Tom is on the edge of his seat waiting to hear them all. Minneapolis Fed President Neil Kashkari, that is today at 6 p.m. Fed Governor Michelle Bowman tomorrow. Thursday, the Fed Bonanza. Fed Chair Jay Powell, Fed Governor Lisa Cook, Chicago Fed President Oscar Goolsbee, Richmond Fed President Tom Barkin. On Friday, we hear from New York Federal Reserve President John Williams. Really key to hear anything on real yields. Earnings, and this to me, it kind of speaks to the same story, Tom. How much do people keep buying if you get their overall expenses continuing to climb? We get earnings on Tuesday from Costco, Wednesday H&M, Thursday is Nike. How much are we looking at a new pressure on consumer discretionary that start feeling it first?
This is nominal. Sales of all this is done in nominal, including Mike McKee's retail sales number. And I usually don't pay attention to this, and I think you're dead on. This time around, the retail pulse is a huge precursor to what we see beginning October 13th with J.P. Morgan.
Anecdotally, we hear people pulling back. When do we start to see that in the granular earnings data on the overall economic data? Yeah, exactly. Again, it's just why would people spend that if they're spending so much and everything else? Economic data this week, home price data, as well as the new home sales that comes out tomorrow. I'm curious if anything's moving, considering the fact that this is basically a broken market. Jobless claims Thursday. And to me, the key day of the week is Friday. Personal income and spending, as well as core PCE data. Again, how much do we see the economic surprises continue to inflect upward in a U.S. that is seeing this quinfecta of threats, this toxic brew of feeling that maybe it's getting difficult. Hexfecta? What's that?
Six.
Yeah?
7.
What do you think Hexfecta is? Like what?
You know.
Vet Bill having a martini?
Yeah, no, we didn't have that. But, you know, again, he has the olives. We've cut him off. You know, they're trying to cut me off, too. I'm going to focus on the VIX 17.84. If you're part of Global Wall Street, arguably this is the conversation of the day. Catherine Kaminsky, and the title's boring, Chief Research Strategist at Alpha Simplex. But far more importantly, out of the Andrew Lowe Combine in MIT Boston is trend-based. She and her shop follow trends in the probability of coming out of a range into some trend across all assets like nobody on the street. Katie Kaminsky to brief us this morning. Katie, I'm going to be honest here. You correlate across some bonds, economics and all that, over to equity markets where you are more than tentative. Tell us about the repricing that we could see in the equity markets.
Good point. Okay, so this year what we've really seen is that the equity market has been disjointed from the fixed income market. So it's been blissfully going along relatively positively, ignoring the fact that there might be some issues and we might need to have higher rates for longer. We feel like last week we finally saw a point of recognition. We saw a breakout in the fixed income market where we saw yields higher significantly on the long end. What this means is the market has really finally said, wait a minute, these upside risks are real. Like higher energy prices, that's a challenge. I mean, these things have to be solved for the equity market to waver through this.
And now we go where the pros fear to tread. Wells Wilder, 1978, with Katie Kaminsky. Katie, cut to the chase. There's a green equity feel of up, 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 and a red down, down, down from Wells Wilder called ADX DMI. It's a toxic soup of calculus as well. What are you learning right now from a broader S&P or NASDAQ 100 ADX DMI available only on the Bloomberg terminal?
Well, if you look at most of the technical signals right now, they all are pretty consistent. The equity has been relatively positive, but a little more tentative recently. But if you look at fixed income, I mean, let's be honest, fixed income is actually set to have 2 years in a row of negative returns. And fixed income signals have been consistently short for months and working well, particularly this month. We've seen energy breaking out more recently, and then we've seen in the currency basket, we've seen the dollar trade also being one of the stronger ones in the last 2 months. So we're really seeing last year repeating itself.
So is that what you're leaning into? I mean, that's my question is, are you basically doubling down on your bond bear thesis and doubling down also on oil prices going higher, or are you seeing this starting to reach a topping point that makes you pull back?
This is a good question, Lisa, because we're not really in the business of picking tops and bottoms. But what we are doing is following where market themes are moving and what people are actually doing. And what people have been doing all year, which has confused me, is sold bonds but said that they liked them. So it's really sort of this weird dichotomy. And so what we're seeing as well is we're seeing continued acceleration in the bond market on the short side, not more than before. So I wouldn't say that we're seeing more short positions. We're just seeing a consistent view. Although we've seen somewhat of a bottom at the short end of the curve. So remember earlier this year, we saw the short end of the curve bottom to some degree. We've been looking for more of a bottom on the long end of the curve. So when are long-term rates going to sell off, or long-term bonds? And that's exactly what we saw last week. And that was our point of recognition, where the market said, wait a minute, you're right. Maybe we have to be higher for longer and we need to disinvert the curve. And that's finally starting to happen.
Katie, I was struck by maybe people capitulate just ahead of the market actually turning their way or the economy turning their way. And it feels like a market that wants to inflict the most pain on the greatest number of people, as markets are wont to do. It feels like things are turning on the edges in ways that might challenge the bond bear thesis and how high yields can go. So is this a point where you start to reassess, this is the capitulation moment where things can start to normalize in a more significant way? How much are you leaning into that?
So what's interesting is we did a study last year. We studied the short bond trade. And empirically, if you look over different cycles of the markets, during inverted yield curves, trend signals tend to work very well being short fixed income. During a flatter yield curve, it becomes more mixed. And as we see a steeper yield curve, then we tend to lean more into longer positions. So that's something we've been kind of monitoring and thinking about over the last year, is this concept of we need to find that inflection point. And since we now have a much flatter yield, look at that 10-year today. It's close to 4.5. That's pretty flat. And so as we see that flattening and disinversion, that means that we're going to see more of that inflection point closer to the bottom of the bond market.
What you just heard there, folks, is gospel from Katie Kaminsky. I can't say enough about disinversion and the point of a tip point, if you will, an emotional point. To pick up on that, Katie, I'm looking at the Bloomberg Total Return Treasury Index. You know it. We're back to 2016 pricing. You mentioned 2 years of negative return in the bond market. For the pros out there, on bills, on notes, on bonds, do they have gamma-like equities? Is there an emotion there where if we break through certain support levels on price, go lower in price, higher in yield, that you get so-called gamma or the emotion, get me out?
Yeah, I mean, that's part of what we've seen recently is at a certain point, you have that aha moment. We had that in short-term bonds earlier this year when people realized, so people have been focused on the shorter end of the curve. But I think right now you're hitting that moment where people are saying, if inflation is higher for longer, longer-term cash flows will be exposed more to that particular pressure. And even if we have higher yields, higher real yields plus inflation is the nominal rate. So we have to have higher nominal rates until we deal with the problems. And the problems are higher oil prices, inflation not going down. It's dealing with supply chain issues and other things that we just didn't have in a low interest rate world.
Katie, thank you so much. 4.49% right now on the 10-year yield. She was quoting Catherine Kaminsky with Alpha Simplex this morning. Monday, Luke Cowell is doing Newtonian calculus way too early in the morning. I just got to know, Quantis hates when I do Greek.
Okay.
Alpha, beta, gamma, delta, omicron, epsilon.
There is a techno song that my oldest son listened to remember all the Greek letters. And says all I could think of, it was like alpha.
Well, you should memorize your Greek letters as well. Katie Kaminsky there. That's a clinic for global Wall Street. The Standard & Poor's 500 this morning, I'm going to call it down 0.1%.
So what are you looking at most this week? I mean, for me, I think
Good
actually,
question.
I
Killer
really
question.
think that retail sales in the United States might be the most interesting part, especially paired with earnings. What about you?
I mean, I think the earnings play into it because that's the hope and the prayer of the soft landing is earnings resiliency. I got China, and I'm underplaying the gloom there. I could be wrong on that. But what am I watching? I think it's got to be the real economy. You know, the parlor game, the Fed, the mumbo jumbo, less important now than, okay, what does Nike do? How bad is it? And all the different earnings that
I
are
would
out there.
agree with that. I don't think that the
Yeah.
Fed speak is really going to have as much of a feature in market response. I think people have moved beyond it, and they're looking at the granularity. But this might be the last data that we get before a government shutdown removes all of the public data. I mean, the retail sales and the PCE, the core PCE on Friday, might be some of the last nuggets of information that we get from the official channels.
I'm just going to go back to the real economy, which is nominal GDP. What does it mean for revenues and the margin, the shock we've seen of constructive margins? But the heart of the matter, and particularly waking up on a Monday and having Purvis come up with Tallback is really important. The basic idea, Lisa, that we're going to go into earnings season and once again be surprised, and everybody's going to pile into 7.5 stocks. That, to me, is what's not expected here.
Although, you know what?
Or do
People
they
are
do
all
better
buying
going down?
the iPhone 15 evidently is crushing it. So
Maybe that Farrell, last sighting of Farrell actually was at Covent Garden. He was in a line outside the Apple
I
store.
love how you just, project
I do,
on everyone. Take the jet stream, spend the time in, Apple stores, singing American
Here's just
Pie.
-4. Yes, we got a message. Is the Bramo Cam with us in our new studios? Yes, the Bramo Cam came with us. This is Bloomberg. Stay with us.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Government shutdown could impact everything from food safety to cancer research to Head Start programs for children. Funding the government is one of those basic responsibilities of Congress. And it's time for Republicans to start doing the job America elected them to do.
President of the United States in for an active week. They're speaking to the Congressional Black Caucus Foundation dinner on Saturday. I would say largely a Democratic room. He'll have to go to Michigan, which is fractious to say the least, of a Republican and Democratic state. One year one wins, Lisa. The next year the other one wins. Trump looks at that as fair ground. There's no other way to put it.
The reason why they're both going to be in
both be there.
Detroit, in Michigan, and I'm curious who's going to gain more traction and whether that's going to take over any publicity from the potential government shutdown.
Welcome all of you. Good morning, Bloomberg Surveillance. We're in our temporary studios here in New York, a little bit different look. Farrell with our interior designers in London. He's picking out curtains for the new studio. studio. We're building here. Lisa Bramowitz and Tom Keene with really interesting markets. You need to stay with us through the morning here as we see if yield adjusts. Equities quiescent to say the least, although a VIX out to 17.90 shows a relative tension over, say, 14 days, maybe 10 business days. 93.41 on Brent crude, 90 West Texas Intermediate. We got to go to the yield space, Lisa. I'm sorry, to walk in and see 2.12% new high 10-year real yield. That shifts the game for any and all.
How many days have we come in and thought that yields would come lower and think that people were going to buy, since everyone was saying that they were buying, and as Katie Kumisi said they were all selling, even though they said they were buying. To me, the key question is what's going to be more important this week? Is it going to be the government shutdown discussions, or is it going to be what's going on in Detroit? Anne-Marie Hordern, fresh off UNGA, is back in Washington, D.C., our Washington correspondent for Bloomberg. Anne-Marie, I'm curious, what's more important to you? What's going on with respect to the shutdown discussions, or what's happening in Detroit?
Well, I think when you put them together, that's when you have concerns for the U.S. economy. Even though shutdowns in the near term don't impact the U.S. economy, they do cost money in the sense that we are paying people to not work, but still not collecting fees, say at a national park. That can cost the U.S. government actually a fair amount of money. But to the consumer, there's not an intense amount of impact of a shutdown. But if you coalesce all these things together, as Stephanie Lowe said in your earlier hour, and you have higher oil prices that impact gas prices, you still have inflation, you have a government shutdown, and you have the auto workers striking, that could be very difficult for the U.S. economy. Obviously, in Washington, I'm laser focused on the shutdown because there's really not a lot of time to get this done. And you do see a lot of positions within the Republican Party feel to be that they're just hardening and it's just taking a lot longer. There wasn't a ton of movement this weekend. They'll be back in session tomorrow. And Speaker McCarthy wants to get 4 appropriation bills on the floor, potentially maybe coming together with the hard right to show an olive branch that he wants to do this by appropriation bills, not just a stopgap funding measure. And then maybe they would allow him to pass a stopgap funding measure. But at the end of the day, anything the House wants to get through, it's not going to work in the Senate. So there potentially could be a shutdown, at least for, as Rick Davis and Jeannie Shanzano say, 48 hours.
And a lot of Democrats have been saying that maybe this could benefit Biden. A lot of the oxygen's being sucked out of the room. I was wrong earlier when I said it's unclear whether President Biden will join the picket line on Friday. He did put out a tweet saying an X post, I will say. I'll go to Michigan to join the picket line and stand in solidarity with the men and women of the UAW as they fight for a fair share of the value they helped create. How awkward is this going to be? Will this be viewed as a victory politically for President Biden or a liability?
Yeah, I'm looking at the president's week ahead schedule, and in Tuesday, it's there in black and white. Wayne County, Michigan is where he'll be to join the picket line. I mean, you had Pete Buttigieg out over the weekend saying the president should be doing this. He's standing with the American people. He's definitely being backed up by the Democratic Party to go join the picket line and go stand in solidarity with American workers. That's the tone from the Democratic Party. Obviously, there are concerns because they're in the middle of a negotiation with the 3 big auto companies. And obviously the president wants to see auto companies in America, as they have this EV transition, also prosper. So the president, I think, is just going to make a show to make sure that he is being seen as the most pro-labor union president in American history. He likes to tout it, and now he's really putting his money where his mouth is. Interesting, this factoid from the Washington Post this morning caught my eye. Labor experts say it's probably the first time a sitting president has visited a strike in at least 100 years. So it really feels like a paradigm shift.
Right. Anne-Marie, I want to digress here for our international audience and frankly for Americans in an iPhone world. I am fascinated how blind Joe Matthew and Anne-Marie Hordern are when looking at polls. We begin this political season, and the New York Times sums it nicely here. You got an NBC poll. You got an ABC Washington Post poll. They're not even close. There used to be this time where people in bow ties came out and said, and this is the way the poll is, plus or minus. It's gone. Do the polls matter, Anne-Marie, now that we're all living on cell phones?
Well, I think the polls matter closer to an election. I think it's very difficult to look at these polls so far out. We're over a year away from the November 2024 presidential election. But it is quite astonishing when you look at this Washington Post ABC News poll, because if even a slight bit of it is true, the Democrats have a big problem. Trump is leading Biden by 10 percentage points in this poll. And if you dig a little bit deeper into some of the details of this data, under 35, Trump is leading in voters aged under 35. Trump is leading by 20 percentage points. This is a group that Biden scored major wins with in 2020, leading by double digits. So yes, at the moment, this is an outlier, but looking at this poll could potentially be concerning if a few other polls start to show up like this. Also within the data, one thing is very clear. Please. Americans continue to give this administration poor remarks on the economy. Even though they tout Bidenomics and they tout the low unemployment rate, inflation still seems to be this #1 concern.
So bring it over to Michigan. I mean, what is the prescription to get that under 35 vote in Michigan? Does everybody show up at a Nickelback concert? What do you do? What do you do in Michigan?
Nickelback, I don't even know if they're still performing, Tom. But I mean,
I priced them for a family outing. They want $750,000 base fee. Let's continue.
I didn't realize the Keene household were big Nickelback fans. Okay, good to know. I think this Michigan trip, the president is going to try to shore up everyone in that state to show he's in solidarity with these workers and their communities, right? So many of these UAW workers, potentially their families also work on the supply chain that are impacted by what is going on. The Democrats want to show we are on the side of workers, less so on the side of corporate America. This administration continuously always touts as well the idea of corporate greed and a low corporate tax rate that they've wanted to bring up after the Trump era tax cuts. That is his mission in Michigan, and why Michigan is so important is because, of course, Biden won it in 2020, but the former president, Donald Trump, was able to flip it in 2016. That was the first time since the late 1980s.
Anne-Marie, are we going to hear about the green agenda on Tuesday from President Biden?
Oh, I highly doubt it. Unless he's asked about it, he'll say that they want to support a fair transition to the green agenda where workers are the first ones from the UAW to potentially get those jobs. But he is not going to want to touch this industrial policy with the Inflation Reduction Act.
Anne-Marie Horton, thank you so much. A terrific Monday brief. Hopefully she'll be here for the Tuesday brief as well. The news flow, just extraordinary. And I loved your question, Lisa, your insight about, okay, UAW strike or government shutdown, particularly if a shutdown is presumed to be 8 days a week and everybody gets paid at the end of it. Oh, we were pretending. I mean, I get to your point. If UAW is long like the Hollywood strike, that's maybe more important.
Especially because you've got posturing from both President Biden as well as former President Trump in Michigan trying to get that vote at a time where it's unclear where the allegiance lies and what the main issues are that are driving it.
We got the encyclopedia, Greg Giroux on this, expert at Bloomberg on all this. But I think Giroux would say, look, the election's there's 50 states last I knew. Yeah. It's only like 10 states or 9, I don't know how many, 9 states.
The swing states that are most important. And this is one of them. And it's really the key issue, which is you talk about, or Anne-Marie was talking about how a lot of people grade Biden negatively with the economy. And it comes down to inflation. And regardless of inflation coming in, costs are going up at a really notable way. And real wages just crossed where inflation was a couple of months ago. It's tough when you're looking at a fixed cost. Gas prices are rising. Your mortgage rates are crazy.
Well, that's what
it becomes a difficult moment.
Everyone feeling that in America. Right now we're feeling a market check in order. Futures at -4, Dow futures at -24. The VIX near an 18 level. The yield space speaks. Disinversion in place. Stay with us. Bloomberg Surveillance.